I'd like to declare open this hearing of the House of Representatives Standing Committee on Economics for the review of the Reserve Bank of Australia Annual Report 2025. I do so by acknowledging first the Ngunnawal and Ngambri on whose lands we meet today, and I pay my respects to elders past and present. I also extend that respect to any Aboriginal and Torres Strait Islander peoples joining us today. Can I also begin by extending a welcome to the representatives of the Reserve Bank of Australia, to also my fellow committee members and to members of the public and the media in the room and watching online. Let me begin, as I did last September, by reiterating the value of these hearings in providing an important accountability and transparency platform. They provide an opportunity for the Parliament and for Australians more broadly to better understand the conduct of monetary policy and the Reserve Bank's assessment of current economic conditions and the outlook ahead. The period covered by the annual report has been one of continued adjustment for the Australian economy. A new phase in domestic economic activity appears to be emerging, with growth increasingly led by private demand, supported by stronger household consumption, dwelling investment and business investment. The latest data shows a record number of Australians in work and the employment rate remaining low. Against this backdrop, Australians continue to face cost of living pressures, and it's valuable to emphasise the importance of careful, balanced policy decisions that support price stability while also preserving the gains made in employment and economic participation. Strengthened private demand suggests growing confidence in parts of the economy and raises important questions about productivity, capacity and long-term growth. The global environment remains uncertain. Heightened geopolitical tensions, shifts in global trade policy, ongoing challenges around productivity and competition across advanced economies continue to shape the outlook facing central banks. More recently, the appreciation of the Australian dollar has added another dimension to that outlook. In accordance with the committee's resolution of 31 July 2025, today's hearing is being broadcast on the Parliament's website, and the proof and official transcript of the proceedings will be published in due course. Given the strong public interest in these matters, I remind all present that these are parliamentary proceedings and must be conducted with decorum and respect. Media are permitted to record the hearing but are asked to report proceedings fairly and accurately to avoid any interference with the committee's work. And they must not film or photograph documents or devices of committee members, witnesses or others. Again, I welcome the representatives of the Reserve Bank of Australia. Thank them for appearing before the committee today. For the Hansard record, could you please state your full names and the capacity in which you appear before the committee?
Michelle Bullock, Governor, Reserve Bank of Australia.
Andrew Hauser, Deputy Governor.
Brad Jones, Assistant Governor, Financial System.
Sarah Hunter, Assistant Governor, Economic.
Christopher Kent, Assistant Governor, Financial Markets.
Tremendous, thank you. I remind you, that although the committee does not require you to give evidence under oath, the hearing is a legal proceeding of the Parliament and therefore has the same standing as proceedings of the House. The giving of false or misleading evidence is a serious matter and may be regarded as contempt of Parliament. The evidence given today will be recorded by Hansard and attracts parliamentary privilege. And with that, Governor Bullock, again, I formally welcome you and invite you to make an opening statement if you like.
Thank you very much, Chair, and good morning also to all the members of the committee. It's nice to see you all again. My colleagues and I are pleased to be here today to answer your questions. As the Chair has already said, these are an important part of the accountability process for the Reserve Bank of Australia. So as you know, our mission is to promote the economic prosperity and welfare of the Australian people now and into the future. And we do this by conducting monetary policy with the aim of maintaining low and stable inflation and full employment, and we also support stability of the financial system. But our responsibilities go beyond this. We work to provide a reliable, efficient and competitive payment system. We deliver efficient and effective banking services to the Australian government agencies, and we also provide secure and reliable banknotes. Since we last met with the committee, the Monetary Policy Board judged that it was appropriate to tighten monetary policy to help return inflation to target. I'll start with some background to this decision and the outlook for the Australian economy. Then I'll make some remarks on the payment system and cash distribution. And I'll finish off with a bit of an update on our progress achieving the objectives of the RBA review. So as I noted, the Monetary Policy Board conducts monetary policy with the aim of maintaining low and stable inflation and full employment. The statement on the conduct of monetary policy sets out our agreement with the government that an appropriate goal is consumer price inflation between 2 and 3%. To achieve this, we set policy such that inflation is expected to return to the midpoint of the 2 to 3% target range. But there's flexibility around the time frame in which we meet our inflation objective to balance this with meeting our full employment objective, achieving the maximum level of employment that's consistent with low and stable inflation in the medium term. Now, on the first part of our mandate, inflation has fallen substantially since its peak in 2022. However, after a period of being within the 2 to 3% target range, inflation picked up over the second half of 2025 to be materially higher than earlier anticipated. Underlying inflation, which is our preferred measure, trimmed mean, which removes the more volatile movements in any given quarter, had been easing, and it had reached 2.7% in mid-2025 before increasing to 3.4% over the year to December quarter 2025. The pickup in inflation over the second half of 2025 was observed across a broad range of categories, including for services, retail goods and the cost of building new homes. Headline inflation, which has been affected by temporary cost of living relief measures, increased to be 3.6% over the year to the December quarter. On the second part of our mandate, various measures continue to suggest that labour market conditions remain close to, if a little tighter than, full employment. After a period of easing, labour market conditions have stabilised in recent months in line with the pickup in the growth of demand. The unemployment rate, which averaged 4.2% in the December quarter, is low by historical standards, and the share of population with a job is close to a record high. There are 1.7 million more Australians in employment since the start of the pandemic. This is a very welcome development for those individuals, their families and the wider Australian economy. Now, earlier this week, the Monetary Policy Board decided to increase the cash rate target by 25 basis points to 3.85%. As I mentioned earlier, while inflation has fallen substantially since its peak in 2022, it picked up materially in the second half of 2025. As recently as August 2025, we were forecasting inflation to be sustainably back within the 2 to 3% band by this year. Private demand had picked up but was not growing particularly strongly. Labour market conditions were easing gradually, and the world economy looked very uncertain, with global growth forecasts revised downwards. But over the second half of 2025, this picture progressively turned around, with a range of data increasingly suggesting that international conditions, domestic demand and inflation were turning out stronger than we expected. The Monetary Policy Board highlighted this evolving assessments in the statements accompanying its November and December meetings. Much of the recent increase in inflation is judged to be temporary, but some of it seems to be persistent. Indeed, our outlook now sees inflation not coming back into the target band until the middle of next year. So what's driven this change in outlook? There are a few factors. First, financial conditions have eased. We previously judged monetary policy to have remained a bit restrictive through 2025, but the recent inflation data and the pickup in credit growth cast some question over this. Second, the world economy has proved much more resilient than expected, so that growth in our major trading partners has been much stronger than forecast. This partly reflects the resilience of the global trading system, which has adjusted faster than expected to tariff changes. But it's also a consequence of the ongoing boom in AI investment, which has spilled over to a number of high-income Asian economies that supply chips and other key inputs. Third, private demand looks to have increased more strongly over the latter part of last year than we were expecting. Household consumption and business investment both drove this strength. Consistent with that strengthening of demand, the labour market has been a bit stronger than expected since November, and we judge that it remains a little tight. We hear from surveys and our own liaison that some firms are still finding it difficult to find staff with the right skills and experience. This is another symptom of excess demand for goods and services in the economy. So given the inflation outcomes, the board judged that stronger than expected demand in aggregate was pushing up against the ability of the economy to supply all of the goods and services being demanded. In other words, there was more excess demand in the economy than earlier judged. This means that we need to dampen the growth of demand unless the supply side of the economy can expand a little quicker, and this is where productivity comes in. Faster productivity growth allows for stronger growth in incomes and spending without the emergence of inflationary pressures. Based on its assessment that the economy is more capacity constrained, the board judged that monetary policy needed to be tighter to dampen aggregate demand growth and help return the economy to balance over the forecast period. It therefore judged it was appropriate to raise the cash rate. Now, there are, of course, risks to this outlook. Forecasts are always uncertain. One that the board will be monitoring closely is the extent to which the stronger inflation we've observed is persistent or temporary. That is, the extent to which the economy is capacity constrained. The board will be closely monitoring the incoming data and continually assessing the extent of capacity constraints. If growth in demand is stronger than expected and growth in the economy's supply capacity remains limited, it's likely to add to capacity pressures and hence inflation persistence. If demand growth is weaker or supply growth is stronger, inflation may return towards target more quickly. There's also significant uncertainties, I don't need to tell you this probably, but in the global economy, with elevated trade and geopolitical risks. Circumstances here could change quite quickly. Now, I recognise the challenges that cash rate increase brings for Australians with mortgages, but it's the right thing for the economy as a whole because we need to ensure inflation's low and stable so that households and businesses can plan, invest and create jobs. I've said it before, but high inflation hurts all Australians, whether you're paying a mortgage, renting, running a business or just trying to make ends meet. And it's especially tough on people with lower incomes and those in more vulnerable situations. So I want to move on now to the payment system, which is another key responsibility for the RBA in our regulation and oversight of the payment system. So we're committed to promoting and supporting a modern and innovative payment system in Australia. We're currently completing our review of surcharging and merchant card payment costs. This review has benefited from extensive engagement from a broad range of stakeholders, that including over 170 written submissions to our consultation paper, and the staff have conducted over 100 bilateral meetings, and they've gathered additional evidence from stakeholders. The Payment System Board will publish its conclusions on this by the end of March 2026. Now, after the review of merchant card payment costs and surcharging, we're going to consult on which issues should be prioritised by the RBA under the amended Payment Systems Regulation Act. These amendments expanded the RBA's remit to a broader range of payment systems and their participants, including three-party card schemes, mobile wallets, buy now, pay later providers and e-commerce platforms. This consultation is expected to take place in mid-2026. We acknowledge that on the 8th of December 2025, this committee commenced its inquiry into schemes, digital wallets and innovation in the payment system. The RBA has made a submission to that inquiry and looks forward to your deliberations. We see the committee's work in this area as very complementary and concurrent to the RBA's own consultations in the payment system. The RBA has also contributed to the Council of Financial Regulators' Better Regulation Roadmap, which is promoting streamlined regulation to help drive stronger productivity in our economy. As part of this, the RBA is supporting innovation by exploring how new forms of digital money can support tokenised asset markets. And we're creating a plan for modernising Australia's core settlement infrastructure, the Reserve Bank Information and Transfer System, RITS, otherwise known as RITS. I also want to note that on the 27th of January, the RBA experienced a system issue that disrupted some payment and property settlement services. We restored settlement for those services in the afternoon, but a second issue for property settlements meant that full restoration was not achieved until the evening. We apologise for the disruption caused by that incident. We recognise the critical role we play in the payment system and we're conducting a full review of the incident, which we plan to publish before the end of February. This incident for me just reinforces the importance of the RBA's active program of work at the moment to strengthen the operational stability of critical settlement systems. I'd also like to update the committee on recent developments in the cash distribution network. So cash remains a critical part of an inclusive and resilient payment system. Although the use of cash for everyday payments has declined in recent decades, a range of indicators suggest cash use has stabilised in the past few years. The RBA remains committed to supporting the Australian Government's policy objective to ensure cash remains a viable means of payment for as long as Australians want or need to use it. The cash distribution system has faced significant challenges. These issues are most pressing for rural and regional areas. The industry needs to work together towards a more sustainable distribution system that supports the needs of all Australians. Linfox Armaguard, which is the main provider of cash-in-transit services, and its major banking and retail customers have been working towards a future pricing model. This is aimed at supporting more sustainable and efficient distribution arrangements. Any proposed model would need to be considered by the ACCC. As the issue of Australian banknotes, the RBA also plays a key role in cash distribution. We provide banknotes to the major banks who distribute these to the broader community. We're continuing to work with industry so that the RBA's arrangements and incentives support efficient distribution and encourage banks to hold cash across the country. We also continue to work closely with other public agencies to support the long-term availability of cash in the public interest. The Council of Financial Regulators, which I chair, together with the ACCC, is taking an active interest in cash distribution. Last year, the CFR and the ACCC consulted on potential regulatory guardrails to support resilience and fair access to critical cash distribution services. The government has also recently introduced a mandate for large grocery stores and petrol stations to accept cash, which aims to support Australians who want to pay in cash for essential goods. Now finally, as you know, the RBA review was released in April 2023. The review recognised the RBA's long-standing contribution to Australia's economic success and the professionalism of our staff, while identifying areas for improvement. It focused on a few key areas: monetary policy, governance, transparency and culture that are central to our effectiveness as Australia's central bank. The findings from the review have shaped our transformation agenda since that time. Some recommendations from the review involved actions that we could undertake ourselves, like changes to the number and timing of board meetings, our board processes, press conferences, and our culture and leadership capabilities. But other recommendations required legislative change, including the creation of a separate governance board. So in March 2025, the most significant reforms to the RBA since the 1990s came into effect. Our work is now overseen by 3 boards: the Governance Board, the Monetary Policy Board and the Payment System Board. The Governance Board is now the accountable authority under the Public Governance, Performance and Accountability Act 2013. It is effectively responsible for overseeing the operations of the RBA, including strategy, risk, resourcing, budget and the balance sheet. But there's one important difference with boards in commercial organisations. We're a policy institution, and so there are circumstances where policy takes precedence over normal commercial considerations. So a good example of this is use of the balance sheet for monetary policy or financial stability considerations. Nevertheless, the creation of the Governance Board has sharpened our focus, strengthened decision-making and improved accountability, supporting our commitment to modernise the RBA. In line with its new responsibilities, the Governance Board published a report on our progress in meeting the recommendations of the review in December last year. To date, the RBA and the government have addressed 41 of the 51 recommendations. Clear implementation plans are in place for the remaining recommendations and the necessary work is well underway. We'll implement 2 further recommendations in 2026, the publication of a framework for additional monetary policy tools and convening of an external expert advisory group on monetary policy. The remaining recommendations are ongoing commitments where we have established the structures, processes and capabilities needed to sustain progress in those areas. They include initiatives to strengthen leadership, embed cultural change, enhance analytical expertise, and deepen our understanding of monetary and fiscal interactions. We have also committed to conducting future reviews of the monetary policy framework and our institutional capability. Our work doesn't end with the implementation of specific recommendations. In the spirit of the review, we are embracing a mindset of continuous improvement, recognising that the environment in which we operate is dynamic and that our institutional practices must continue to evolve. We remain committed to pursuing excellence in everything we do as we build an RBA that is fit for the future. I'll finish on that note, Chair, and my colleagues and I look forward to answering your questions. Thank you.
Appreciate it. Thank you very much for the opening statement, and I think that's now gone up online as well if people want to track that down. On just picking up on some of the things you said in your statement as well as remarks you've made this week, you obviously indicated that this week presents challenges, but there's also, in terms of the broader economy, but you also said we're actually in a good position. The labour market's really strong, domestic demand's recovering. These are good things, but it's just that we're supply constrained. The latest statement on monetary policy noted private demand is driving growth. On top of that, the latest quarterly estimate of key economic flows in the country indicated private investment grew at nearly 3%, which is fairly significant given it's been a challenge for some time. And it's probably the highest rate of quarterly growth since March 21. So I just want to ask three quick questions, if I may. What are some of the factors that the RBA has noted has driven that pickup in private sector activity? Do you view the pickup as the start of a more sustained investment cycle? And what are some of the factors driving that? And to what extent could this lift in investment translate into stronger productivity, given you highlighted that importance of that in your statement and potentially addressing some of those supply constraints? So the factors that drove the pickup, is it more sustained, and the extent that it could translate to productivity?
I'll make a few comments, and I'll ask Sarah to make a few comments as well about... So the factors driving, I think there's a couple of things that have occurred. The first is that real incomes have been rising for a while now, and that's helping to sustain growth in incomes. And real disposable incomes, they've been assisted by the decline in inflation, they've been assisted by tax cuts, they've been assisted by interest rate cuts, all these sorts of things, and rise in nominal wages. So all of these things have been contributing to an increase in real wages, and that's been helping to sustain consumption. Investment, you're right, it was very strong, and I'll get Sarah to make a few remarks on investment. I think our hope is that it will be sustained. It may not. It may be that some of the strength we saw is a little bit sort of lumpy. It's lumpy investment. So we expect that some of that may not persist as big lumps, but hopefully it is signalling that there might be a little bit of a pickup, and I think we do have. I'll ask Sarah to talk about the forecasts and investment. So I think that's positive. We need investment if we are to get productivity improvements. We need two things. We need investment so that we can get more labour productivity, but we also need businesses to be thinking about how they combine labour and capital in more efficient ways to get productivity improvements. Certainly our analysis of productivity at a high level is that both of those things have not been occurring, and that's part of the reason for the slowdown in productivity. But I might ask Sarah to make a few comments about the outlook particularly on investment and consumption.
Yeah, absolutely. Thank you, Michelle. So for business investment, what we particularly saw in the September quarter was a big step up in investment in data centres. That we weren't actually expecting that, and that investment can be very lumpy, as you can imagine. You build a data centre, it's worth a lot of money, and it sort of pops through in one go. But I suppose somewhat encouragingly, at the same time, we also saw in firms' expectations for their capital expenditure over the next year, that also stepped up. So while we don't expect to see the same again in terms of that jump in data centre investment, we do now think that, generally speaking, business investment will be higher than we previously thought over the next
Based on
year or
CapEx
two.
intention?
Yeah, which is a survey the ABS run, and it's sort of what it sounds like. They ask businesses, what do you expect to spend in terms of your capital investment over the next year? And that gives us a steer on where we think actual spending will go. So investment is stronger, is the bottom line. And in terms of your question of how does it flow through to productivity, we would certainly hope to see that having an impact down the track. Clearly, business investments, expanding the capital stock, investing in new technologies is a key part of how we can lift productivity in the economy. It does take a bit of time, though. So you put that capital investment in place. It might take your workforce a bit of time to learn how to use the new machinery and equipment and whatever else. It could take a bit of time for businesses to take full advantage of the new AI technologies and that are enabled by these data centres. But we would hope over time that it would contribute to productivity growth. Might be beyond our forecast horizon, which is only a couple of years, but down the track, yes, we'd hope that would be true.
Thank you.
Chair, could I just add a word?
Yeah.
The other factor that we have seen, it hasn't been the primary driver of the pickup in demand last year in Australia, but it's an important contextual point, is that the world economy, although many downside risks, and we're very conscious of those, some of them crystallised last year, has been surprisingly strong, in fact. And whereas many of us marked down our forecasts for growth last year in light of the tariff announcements, in reality, and you know this, world growth has been stronger, not least in the major trading partners of Australia. So commodity prices have held up, and the Asian countries have had surprising booms, surprising to themselves, in fact, because of the AI and tech cycle. And so that is also part of our story, most importantly in 26 and 27. But it's another upside surprise that I think nobody had fully predicted 6 months ago.
Thank you. That brings me to the second area. There's two other areas I wanted to touch on in the time that I've got allocated. And that brings me to the global outlook and your references to it in your opening statement, Governor, and just some of the comments that Andrew made then. In terms of the risks within the global outlook, given some of the geopolitical instability that we've been witnessing and some of the political uncertainty in advanced economies, what are some of the channels through which this might impact on our economy? How do you see some of these risks playing out in the global economy itself? And do you think we're well placed to be able to manage some of those risks too?
So there's many facets to this. So back in April and May, when all of this was at its height, when the tariffs were initially imposed and the US effectively cut off trade with China, and then everything subsided. But at that time, you might recall, everyone was extremely worried. And we did some scenario analysis, which we published in our May Statement on Monetary Policy, which looked at basically a global trade war. And that involved the US following through, lots of retaliatory tariffs by other countries, which would have a big impact on global growth, and that would impact us. But our direct exposure, and there was an expectation that the US would slow down quite a lot. As Andrew has already said, none of this came to pass, and there's a number of reasons for that. The tariffs didn't end up being as high as they were expected to be, certainly not as high as expected in April, but even now there's so many exemptions and so many uncertainties about where they apply, the actual tariff rate's probably even lower than the headline tariff rates in many countries. So that the global trading system has managed to find ways to redirect trade. China's still exporting at record volumes to the rest of the world. It's having an impact on, as Andrew said, on our other trading partners, particularly in Asia. Everything seems to be rosy, and certainly the financial markets seem to think everything is rosy. I'd say that risk at the moment, it wobbles. but generally risk premia are pretty low in the world economy. Financial markets don't seem to be thinking that something disastrous is going to happen. Mm-hmm. So what if something happens to cause this to unravel? Well, I think our exposure is mostly in terms of trade, obviously, to China. So if something implodes in the US and it slows down markedly, that doesn't necessarily impact us as much as if it has flow-on effects to Asia and to... so that's the first point. The second point is that financial markets are very, very sanguine about all of this. It is possible that it won't be trade, but maybe geopolitical events that cause financial markets to go into reverse, start pricing a lot of risk to assets. Mm-hmm. And if that happens, there are potential risks to the financial stability. If that happens, banks might start, financial institutions might start withdrawing credit. They might start seizing up. In that case, that sort of, because credit, of course, greases the wheels. If they start to do that, then that's potentially presenting financial stability issues, which will impact the real economy, and we've seen that in the past. So there are a couple of the mechanisms through which it might. It's as Andrew said, everything is surprised on the upside, and not just us, everyone. When you go to overseas meetings, everyone is surprised on the upside.
The last issue, thank you very much for that. The last issue I just wanted to touch on before I hand over to the Deputy Chair. Globally, we're seeing a pretty active discussion, is my sort of euphemistic way of describing it, around central bank independence. You're one of more than 15 central bank leaders around the world to sign a joint statement offering full support to the US Federal Reserve Chair. Getting that many central bankers to sign a statement like that's a statement in itself. You clearly feel strongly about this issue, and I just wondered if you're able to expand on your reasons as for why you were part of that statement.
The reason, I won't comment on sort of US politics or anything like that. All I would say is that
there's enough of that going on.
The Federal Reserve Chair's statement that his independence was being challenged, and he felt he needed to stand up for that, and we, myself and I know others as well, also felt it was important to stand up for central bank independence. The reason being that for a long time now, many decades, I think it's been clear that giving central banks independence but accountability, independence to set monetary policy to keep inflation low and stable, which mandates for central banks differ a little bit, but basically the core of most of them is all about keeping inflation low and stable. That's what it's about. And giving central banks independence from political processes to do that has proved very, very advantageous for the world economy, allowing monetary policy to do that and governments to get on with their things. So that's the reason that I signed it. I thought it was important. And you do periodically see countries where the independence of central banks is curtailed, and generally you don't get very good outcomes either for inflation or for the economy, because as we know, if you let inflation get out of control, it's bad for the economy generally, it's bad for employment, and ultimately the cost of getting it down can be very high.
Thank you. Okay, I'll hand over to the Deputy Chair for your question.
Thank you, Chair. I'll just pick up where you left on inflation and this week's rate rise. I think in your statement on Tuesday with the rate rise, you talked about excess aggregate demand in the economy creating inflation pressure. You touched on that, is that?
Yep, that's right, yep.
And does government expenditure influence aggregate demand?
Yes, so let me just talk a little bit about what aggregate demand is. So when we talk about aggregate demand in the economy, we're talking about a combination of private sector demand, which is consumption, investment, and public demand, which is across federal, state and local governments. So that's what goes into aggregate demand. And what we were talking about in the statement was that aggregate demand, we think, is currently in excess of the ability of the economy to supply those goods and services which are being demanded. So the total demand is too high to be supplied, and that's what's giving inflationary pressures.
And I work in Parliament and we do the budget, so we focus much more on expenditure. So I guess my question to you was on government expenditure, fiscal policy. Does government expenditure influence aggregate demand? So government expenditure, as I understand it, creates public demand, but there's government expenditure also in private demand. Does government expenditure influence aggregate demand?
Yes, it does, because as you say, there's some public demand, and then there's transfers and taxes, which also flow into that. So it's all part of aggregate demand.
And when will government expenditure peak? Excluding COVID, when will the highest as a percentage of GDP or economy, when is government expenditure peaking?
Sarah, I'd have to pass to you on that one.
I mean, it depends on, to your point, actually your previous question, it does depend on how you define.
So percentage of GDP, when will it be the highest?
Well, so it depends on if you're talking about public demand in aggregate demand. Which
payments,
is
let's talk about payments. Government payments, when will they peak as a percentage of GDP?
So I don't have that figure to hand, and you can find that figure in Treasury documents. They will typically report on that, but they would, and it depends on which.
So I've got them here, since you don't have it, but in MAEFO, it's saying it'll peak this year at 26.9% of GDP this financial year. Does that sound right to you?
I'd say I don't have it in front of me, but if you're reading it from the MAEFO document, then that will be the Treasury's forecast for what they expect for federal government expenditure. That obviously won't include the states, local, which is also very small.
So, and I'm in federal government, so I'm just talking about federal government and the federal government's actions. So we've got excess demand creating inflationary pressure, which you've just said. According to Treasury's documents, we're saying government expenditure, excluding COVID, will never be higher than this year as a percentage of the economy. It is the highest it will ever be, excluding COVID, in 30 years. So if government expenditure, as you've just said, influences aggregate demand, as Keynes would agree with, if it's never going to be higher in 30 years than this financial year, is it not then logical that government expenditure is putting pressure on private demand and putting pressure in interest rates? What is wrong with that logic that I have just laid out?
Mathematically, you're right. Public demand, expenditure and private sector, all of that adds to demand. That's logical, it's mathematical, that's what happens.
Good, I just want to make clear. So just for the record, government expenditure peaking, the highest it's been in 30 years, excluding COVID this year, is adding to aggregate demand, creating inflationary pressures.
It's a component of aggregate demand. So I think
it's the largest it's ever been as the component.
I think
is that fair?
I think as the Governor's outlined, what we're really concerned with is what's happening to aggregate demand. That's what matters for inflation. But the reason I sort of say that is because what we have seen over the last few years and what we've seen throughout history is that the economy will adjust and you get different spending patterns at different points in time. But it is aggregate demand that matters. So the economy will adjust to where the demand is coming from. So if one particular sector or region is growing more strongly, you'll tend to get people moving to that sector. They'll move into jobs, they'll meet that demand and so on. So what we care about is aggregate demand. And the reason I stress that is because it doesn't just matter what the federal government does, it does matter what the states do, what local authorities do even, the small component, and it matters what's happening in the private sector, and it's that total.
But all this government can control is what it does, is that fair?
Well,
and that's what we're here talking about, and that's what I want to talk about. So
the government is responsible.
On Tuesday, Treasurer Chalmers said this: if you look at the Reserve Bank's statement today, it does not mention government spending. Well, that part was right. But then he goes on to say it's not a factor in the decision they took today.
It wasn't. So what the statement said, where we were surprised, and I said this in my opening statement, if you look at, let's just go back to the facts here, right? And they're facts. They're not judgments, they're not opinions.
And I just want facts too.
Over 2025, if you look at our forecasts, which are the relevant things for inflation forecasting, right? It's about aggregate demand and aggregate supply. We've already established that in aggregate demand there is public and there is private. Over 2025, the contribution of public, and you can see this in our statement of monetary policy, the contribution of public demand to growth has declined, and private demand
But just
has
to
recovered.
interrupt you there, because I'm talking about government expenditure. So government expenditure, I know you're going back to private and public demand, but isn't it the truth that in private demand, there's government transfers? So government expenditure, and what I'm focused on is government expenditure. I know you want to go back to private and public demand because, yes, public demand has come off a little bit, but what that obscures is that in government expenditure actually shows up in private demand, does it not?
Yes, it does, because what it often does is it transfers money to people and it gives them money to spend.
So why I don't like that, and I'll just be honest, because I think what the Treasurer is trying to do, and I'm not accusing you of this, is be a little bit tricky here, because he doesn't want to admit that government expenditure is the highest, excluding COVID, it's the highest it's ever been in 30 years right now.
Well,
and by him talking about private demand and public demand, that obscures the fact that government expenditure, which is in public demand and private demand, with electricity rebates, with all these other things that don't show up in public demand, and it tries to give him a political out to obscure. And what he said here, which is if you look at the Reserve Bank statement today, it doesn't mention government spending. He's not talking about public demand, he's talking about government spending. It is not a factor in the decision they have took today. And I want to talk about the Treasurer's words, not your words.
I don't have a view on the Treasurer's words.
Well, the question is that statement correct?
The statement is, it is correct to say that if you look at our forecasts, what has driven the rise in inflation, and you see this is, and I know you're talking about spending, we're talking about public demand, has declined as a share of the contribution to the growth in spending, in growth in GDP. That is a fact. That's the way we forecast. We're not Treasury. We forecast based on aggregate demand and what we think that means for the supply gap and what that means for inflation. That is our focus.
Sure.
And if we need to put up interest rates to slow the growth in demand, in aggregate demand, then that's what we will do, if that's what's required to.
And that's your job, and I don't want to. And I'm not trying to challenge you on your job, but my job in opposition and in government is to look at how the government spends all the taxpayers' money that they get.
That is.
That's my job, and in opposition.
That's your job, and it's the job of the government and the Parliament.
And I think government, when it spends in its fiscal policy, creates settings monetary policy makers need to take into account. Is that fair?
We need to take into account what is happening in aggregate demand relative to aggregate supply, and yes, all that feeds into aggregate demand. But as I've said before, fiscal policy decisions are decisions for the government and the Parliament. They are not for the Reserve Bank of Australia. And
I don't want you to influence or make those. I'm just trying to understand, in my role, which is separate to your role, whether, and I need to scrutinise government spending, whether that affects monetary policy decisions. Now, I think what I heard in the testimony earlier is government spending affects aggregate demand, which is how you set interest rates, so it must.
Well, it does, as does private. I mean, it's
Well, that's, and I'm just
part
trying
of aggregate demand.
I'm relieved to hear you admit that, because when I was listening to the Treasurer in Parliament here on Tuesday, when he said that, it didn't sound right to me, so I'm very relieved to hear you say that. And and it has been such a contentious point, and I'm not sure why the Treasurer's had such a hard time doing it. So apologies, I know that felt a little laboured, but we've had a week like that, so at least you've only endured 10 minutes of it. So
it's factual. It is not an opinion. It is not a judgment. It is a fact. That's all it is.
Yep. And I might turn to the economy. Earlier, I see that you have revised down your predictions for growth on the economy. They were, let me just pull them up. Following up on yesterday, this is a quote from the ABC, following up on yesterday's rate hike, the RBA has slashed its forecast for economic growth. In November, the central bank thought GDP would be 1.9% this year and 2% next year. Now it thinks it will fall to 1.8% this year and 1.6% next year and the year after. This is a shocking downgrade in Australia's economic performance. So are Australians at risk of getting poorer at the moment with this downgrade?
Well, I'll defer to Sarah on the specifics of the outlook and the downgrade, but a couple of things. Previous forecasts basically had further interest rate cuts in them because we thought that the economy was slowing and that inflation was coming down. The new forecasts actually have a technical assumption where the interest rate is going up. So that's part of the explanation.
So continued interest rate rises?
It's a technical assumption.
Yep.
It's not our forecast for interest rates. It's a technical assumption, but that is part of what's driving the forecast. Sarah can talk to that more explicitly in more detail. But the point about people's incomes going forward, that's a story about productivity. Unless we can get the economy growing, potential supply growing more quickly, productivity growing more quickly, then we can't grow any quicker than that. And we need that. We need supply to respond. We need productivity. That means that we need to produce more for the capital and the labour that we are investing in producing things. And unless we get that, then in the future, we're not going to see a lot of growth in people's incomes. And
so what are you forecasting in productivity growth?
So we have a assumption, I think it's about 0.7 for the next couple of years. It's only a short run assumption. It's not a long run assumption, but for the next couple of years we see it as relatively subdued. But I might pass to Sarah.
And then just comment, Sarah can pick this up. So with that growth assumption and with that productivity assumption, should Australians expect to get poorer on average?
I can pick up on all of that. So no is the answer to your final question. So what we have for trend growth, so that productivity assumption that Michelle just mentioned, around about 0.7 year on year for our 2-year forecast horizon, that gives us a trend growth rate of around about 2% year on year. That's stronger than population growth. So on average, over the medium long term, if that's what came to pass, no, on average, GDP per capita would be rising, real household income would be rising under that outcome. But to go back to a bit more detail of the forecast and the forecast revisions from November, to answer your earlier question, just to give a bit more colour. In November, we were actually expecting the economy to grow at around about that 2% mark for the next couple of years. So that gives us a sort of baseline what we're thinking we would get around trend growth. What we think now is actually that the near term is going to be stronger than that. So we have actually upgraded what we thought for the back half of last year, as Michelle has already talked about, and we've upgraded a little bit what we thought or what we think is going to happen for the first bit of this year. But as Michelle said, with our new technical assumption for the cash rate and some other factors easing away, we do get a slowdown to below trend growth in the back half of the forecast. So it's more of a cycle now around that trend growth rate. So yes, the out year, 2027 into the first half of 28 is weaker than we had in November, but the first half of the forecast is actually, if anything, stronger. So I wouldn't quite characterise it the way the quote that you said did, but it's more of a cycle around that trend growth rate.
Thank you. Thank you both.
Okay, I might invite the member for Wentworth to do her 10 minutes of questions.
Thank you so much, and apologies for not being there in person. I'm afraid I had committed to things before we had arranged this date. I just want to pick up a bit on what the Deputy Chair's questions were, and it's really about managing risk. Having been on the Economics Committee for a bit, it seems that it's not a complete science. It is also an art, and it is about it's about how do you manage the risks of inflation as well as the risk of unemployment and the risk of big hits to growth. And I want to come back then to sort of government spending, because I note in a statement of monetary policy graph 2.12, which shows that the collective Commonwealth and state budgets are going to have grown in deficit for the last couple of years, so 1%, 2%, and are expected to get to 3%, I think, this year. And I guess wanted to ask, really, as we look into budget, and we're starting to think about the next budget, how can fiscal policy reduce the risk of sustained higher inflation at this time?
2.12, did you say?
What page is that on, Allegra?
It's page 27.
Consolidated,
Sorry. It's
the underlying cash balance.
Mm-hmm. Yeah.
So do you want to talk about the underlying cash balance?
I can talk about what...
I'm probably just talking about government spending and saying, as we think about how to manage budgets going forward, how do we reduce the risk of inflation in fiscal policy, and particularly in the level of government spending? Okay,
so the government spending, I'm not going to talk specifically to that graph, but government spending, as we've already established, is part of aggregate demand. So mathematically, if government spending declines, public demand doesn't grow as quickly, if you like, then that will bring down aggregate demand unless the private sector picks up the slack. So at the moment, if we think we're pushing up, which we do, we think we're not just pushing up against supply, we think we're in excess demand, then if both public and private reduce growth rates, that will help to close the gap between aggregate demand and aggregate supply. What we've got to do is close the gap. We thought we'd close the gap. We now think we haven't closed the gap. So you need slower growth in aggregate demand, and both public and private could contribute to that.
Okay. Thank you. And I guess the fact that we expect greater budget deficits across the state and federal governments, is that of concern when you're looking at forward in terms of, I guess, the outlook for what private demand we can sustain over the next period of time without increasing inflation?
So those numbers that you see, they are incorporated in our forecasts. So we take those numbers and we basically put them through our models and our judgment, and we decide what does that mean for the inflation outlook. And the outlook we have is that inflation peaks and then it starts to come down again, and it gets back down into the target by 2028. So that's what those numbers are contributing to. It's not the sole cause.
Yeah.
It's just contributing, as is private demand, to that inflationary outcome.
And then the next question is really where Australia is around the world, and also sort of relating to the dual mandate of the RBA, because I note that Australia's inflation rate now is sort of out of step with the euro area, US and Canada, which are significantly lower than ours. And we have a dual mandate in the RBA, which is both to reduce, to keep low inflation and as low employment as possible. How are those two things have been traded off, and do we have the right trade-off at the moment?
So, as I said earlier, central bank mandates vary a little bit, and the Fed in the US, their mandate also is a very explicit dual mandate. You will hear them talking about employment as well. One sounds trivial, but isn't really, is that our target is 2.5%. Their targets are all 2%. So, in fact, the Fed is probably as much above their target as we are above ours at the moment. So you can't just sort of compare in that way. So that's sort of trivial, but I think important in a way. So with our dual mandate, we took and I've said this before, the board took a very explicit strategy of trying to bring inflation down, because we have flexibility in the time we can do it. We decided to try and bring it down at the same time as we didn't result in too much loss of the labour market gains we'd had, and we didn't end up. And in many ways, the position we're in, although everyone's talking about it quite negatively, it's actually quite positive. The reason we're in this position is because the labour market is still doing really well. And it's stabilised, and it's stabilised at a relatively low unemployment rate. This is good news. And I think people sort of forget that. Okay, we've got inflation still a little bit high, so we've probably got to work on that a bit. We think there's some temporary factors in there, but we think there's a little bit of persistence. That contrasts with some other countries, and I'd probably speak about Canada and New Zealand here. They took interest rates much higher than us. They got inflation back down, but they've both got very high unemployment. Canada's got a 6 in front of it, New Zealand's got a 5 in front of it. So they took a different approach, and now they've got lower interest rates because they're now trying to bring employment back now. They're trying now to have accommodative monetary policy so that the economy can recover a bit. So that's a sort of a different approach. We could have taken that approach, but we didn't. And yes, we've always thought it would be difficult to achieve, but I think it's something that's worth achieving. At the moment, I think you will see, we think probably now the risks are more on the inflation side. So that's why we're responding to that. We've got an eye on the unemployment rate and the employment market more broadly, but at the moment we think the risks are skewed up towards the inflation side.
Okay. One question, you talk about temporary factors, and a question that has been asked, a question I've certainly asked is, the government brought in a policy. We saw a lot of house price inflation in the last quarter, and the government's policy in relation to did a significant policy in terms of loan guarantees, expanding the eligibility of loan guarantees for which. By some measures, has driven some house price inflation. I just wanted to understand how has the RBA looked at that specific policy, because it may have a short and long-term effect, but it may have more of a short-term effect. And how do you assess the impact of that policy, if you have assessed it, on the impact on house prices and inflation?
So we've done a little bit of work on that. I think we answered a question on notice for the Senate on this for Senator Bragg, so I'm sure that's on the public record. We have done some work on this. Sarah, do you want to speak about it?
So Governor Bullock is correct. We did some ex ante analysis of it, so when the policy was announced, but before it became active. Our assessment was that it could potentially have a small impact on aggregate house prices. Obviously, it's targeted at just one particular group, first home buyers. And within that group, it would only make a difference for those that were otherwise constrained by needing to take out LMI. So we think it would have a small impact in terms of the established housing market. In terms of it coming through into inflation, so house prices are not captured in the CPI.
Yeah, sorry, no.
So there's no direct impact there, so we haven't seen any impact there. It has the potential via indirect effects, if there's a wealth effect for households coming through, or how it interacts with the housing market and potentially flows ultimately into dwelling construction costs. But we would expect those channels to come through much, much later. So we don't think that any of what we've seen in the consumer price index is attributable to that policy.
Okay. Thank you. I guess the last question is, what is, I guess, from that point of the housing prices, what's your perspective in terms of what is really driving this significant part of inflation? Well, what are your concerns there?
It's construction costs and rent, I think, isn't it?
That's what is captured in the CPI.
Yeah.
And both of those markets really very driven by the basics of demand and supply. So we know that there's been a housing shortage in Australia for some time. We've talked about it. Many, many others have talked about it. You can see it in the rental market. Rental vacancy rates are still very low. That means there's a lot of people trying to find a place to rent, and then that pushes their rents up. And in terms of dwelling construction costs, we have actually seen a bit of a turnaround in inflation in that category in recent months. And what we hear through our liaison programme and what we hear reported from the ABS on their website is that some builders have been able to take out discounting that they'd previously offered to get new clients. They feel they don't need to do that anymore because demand has picked up. And so that's then coming through into the prices. So those two very basic economics markets are functioning and are indicating tight markets. So that excess demand that Governor Bullock was talking about earlier.
Well, thank you very much for your time. I'll pass back to the Chair.
Terrific. Thank you. Member for Bennelong.
Thank you, Chair. I've just got some follow-up questions following some questions from the Deputy Chair. And One word that piqued my interest from the Deputy Chair was that you thought your answers were an admission, particularly around aggregate demand. It's just fact that aggregate demand takes into account both public and private demand, isn't it?
Yes.
Yeah, and as the payments board, not the payments board, sorry, you can tell where my head's been, as the monetary board looks at decisions on interest rates, they take into account aggregate demand.
Correct.
Okay.
It's about the inflation
Yep.
issue at the moment we judge is about excess aggregate demand.
Mm-hmm. Okay. And delving into your comments today and also your statement, you see public demand easing and you're surprised at the increase in private demand.
So what, and these are facts, they are not judgments.
Yeah. Oh, surprised is your word, yeah.
We were, and I'm talking about public demand, not public spending, I'm talking about public demand. If you look, and it's in the Statement on Monetary Policy, public demand's contribution, not public spending, public demand's contribution has declined in the first, and we were surprised in the first half of 2025 that it declined as much as it did. Mm-hmm. And we have been surprised in the latter part of 2025 about the strength of private demand on the upside. So they are facts. If you look at the graph, you can see very clearly.
And you mentioned AI as one of the industries that has grown, investment in AI. Were there any other areas of private demand that you were surprised at in the last quarter of 25?
Well, I think we were surprised at consumption, weren't we? That was a bit stronger than expected as well. And I think partly real incomes had turned out to be stronger than we had thought as well. So that was driving part of the consumption side of things. Is there anything you'd add, Sarah?
Just a bit more colour and detail, I suppose. So you can actually see it in our forecast table as well. If you look at where the revisions to the forecasts have come, they've come really in the private demand components. It's actually all three of them. So as Michelle's already mentioned, business investment came through stronger, as we talked about earlier on, and that's where investment in data centres and other AI technology would show up. Household consumption, we think, ended last year on quite a strong note, and as Michelle has just said, part of our assessment of that is that household income has actually been a bit stronger. We got some data revisions that suggested household income growth had been a bit stronger than we previously knew about. And we've also had a bit of a surprise on dwelling investment as well, so that's building of homes. That's very welcome if that lifts supply, but there's a long way to go on that, and it does take time, particularly if you're building high density. That's a sort of 2-3+ year solution. It's not something that resolves the problem of a housing shortage in the near term. But all three components have come through a bit stronger.
And so, under the former government, there was near a decade of stagnation on real wage growth. Didn't move that much. I would imagine citizens would welcome a period of real wage growth, and you're seeing that sort of play out in the numbers towards the end of the 2025.
Real disposable incomes have been rising, yes, that's right, and there's another graph in there which shows you the contribution to that.
Okay, and aside from, and in business investment, obviously an important factor in increasing productivity rates. So that is also, it's surprising, but it's also welcome, right?
It's very welcome because if we want to see decent real wage growth without inflation, we need productivity growth. Real wage growth basically is about rewarding labour for producing goods and services, and if they're more productive, then their wage can go up.
So ideally, coming into 2026 and future reviews from the board, you'd like to see a continued increase, particularly in business investment, to make sure that productivity increases.
We would like to see certainly business investment continue to pick up, and we're forecasting some of that.
So a good outcome in the 2025 numbers. Okay, I just have a few more questions in regards to government Easy Pay. That's a service that the RBA runs for government agencies, and yeah, is that okay? Does the RBA government Easy Pay service use least cost routing?
Look, actually, I'll have, if there's specific questions on Easy Pay, I think I'll have to take them on notice because I'm not au fait with the details of the banking relationship. So I don't know the answer to that question.
Okay.
So.
I popped on recently to have a look, and I noticed that payment options are Visa credit, MasterCard credit, Visa debit, MasterCard debit. We've got a domestic debit payment provider in FPOS. Why doesn't RBA, and sorry, according to your numbers, FPOS is about 20% cheaper in debit than Visa and MasterCard. Why doesn't Government Easy Pay offer FPOS debit?
I'd have to ask that to our provider.
Okay.
So we're not an acquirer. We have to contract someone else to offer those for us. So I'd have to, again, the details. I'd have to understand what the contractual arrangements are with that provider.
Yeah. My only concern is that, I mean, I think the government made the right call in not charging fees for debit payments using government payment services, and so that costs the Commonwealth and taxpayers $10 million a year.
Yep.
Not 10 million. Yeah, but it will cost them $10 million a year by a certain time frame in the next few years. My concern is that as the Commonwealth is now absorbing that cost, the RBA isn't using what it knows to be the cheapest provider.
I mean, I guess I'd make a couple of points. For people paying the government, we don't control how they choose to pay. They choose credit or debit. Now, I don't know the issue. I don't know about least cost routing, but I do know that if someone chooses to front up with a credit card, they should front up with a credit card for that payment.
But if you least cost route and they've got a dual service card and they pay by debit, it'll go for the cheapest, which will save taxpayers potentially 10, 15, 20%.
Potentially, but again, I don't know the details of the Easy Pay arrangement with our provider. I'd have to go and look. I'd have to go and look at the contract.
Oh, yeah, look, I know it's FPOS debit has been available online through least cost routing for a number of years now. Particularly given that now the Commonwealth is picking up, and rightly picking up, the bill for not charging a surcharge on debit payments. I'm a bit concerned that the cheapest form of debit payment out there is still not available to a very large payment service. ATO runs through that. I think Centrelink runs through that.
And look, you know, it's a decision for our customers what payment mechanisms they want to accept. They can accept direct debits as well, or direct credits, which are cheaper again.
They are.
You know, the decision on what to pay with rests in the hands of the payer, but the options they've got rest in the hands of the government departments that are accepting the payments. And if they choose to accept credit payments, then that's their business. We'll facilitate it for them, but that's their business. They could choose not to. They could choose to say, no, we will only accept direct credits. And we've got also got a great payments platform now that gives instantaneous payments. So they could do that as well.
Yeah. Well, I'll put a lot of those questions on notice if I'd like to understand what plans there are, if any.
Okay, I'll take that on notice.
Great, thank you. One more question from me, that's all right. Chair, the RBA move. We asked a question, I mean, I think Mr Pike asked a question at the last hearing. Just wondering if you could provide us with an update on the progress of that move.
Of the what, sorry?
The moving of your headquarters at Martin Place,
yeah, sure.
How that's going.
So where we are with that at the moment is that we have had, we've approved a first part of the development application, so it's a first development application. That was to basically remove all the asbestos from the building and effectively demolish the building. The problem, as I think I might have mentioned, is that once it was supposed to be a renovation. but as we started to renovate, they discovered asbestos, 4 to 5 more times asbestos than in buildings of equivalent age. So we had to move all the staff out. We were all planning to basically stay there and shuffle. We couldn't do that. We had to move out. So at the moment, we're in the process of actually moving all the fittings. We've done, I think, 5 floors. We've removed the asbestos basically from 5 floors. There's another 25 to go. And we're in the process of developing a second development application, which is for basically the rebuild of the building. And that involves basically also preserving heritage, because it's got heritage value. That development application is, as I said, not complete yet. We're still working on that. And we also have to go to tender for a developer or a builder to come in and do the rebuild for us. We've got one builder at the moment doing the removal of asbestos and demolition, and then we'll have another tender to select the appropriate party to do the rebuild for us. So that's where it's at.
So accurate cost probably won't be available until you go through that tender process?
Well, the cost at the moment, I think, that we've got in the public is 1.2, but obviously we've got to get some costings once we get the tenders done for the second part.
And you wouldn't want to forecast that if
well,
you're going through a tender?
That's challenging, I think, at the moment, what we know about building construction.
Yep.
Okay, thank you. Over to the member for Casey, who apparently follows some football team or other based on the background. Over to you, Mr. Violi.
Appreciate it, Chair. The 2023 Premiership makes me happy all the time, so I appreciate that.
Governor, there we go. We start on a positive note. I love it.
I apologise that I can't be there in person. Governor, just very quickly, how many times have you met with the Treasurer in the last 6 months?
In person, I have met with him. I met him once in Washington, I think, at the meetings, and I met him once in my office, and I have phone calls with him maybe once a month, so maybe half a dozen.
Fantastic, thank you. We're very lucky and honoured in these roles to represent our communities, and the questions we ask are not just from ourselves or our parties, they're for our communities in the country. And so I reached out to my community asking what they would like to ask you. And I just want to read a question from Matt from Lilydale, he would like to know 2 questions. How has the government spending affected the economy? Has it contributed to the rate rise?
Well, first of all, thank you to Matt for the question. I think we've answered that question, but if I could summarise, government spending is part of total spending and total aggregate demand in the economy. So it, along with private spending, contributes to aggregate demand. And so to the extent that aggregate demand is above aggregate supply, which we think it is, that's contributing to inflationary pressures, and that's why we've decided to raise interest rates just a bit.
Perfect, thank you. As you can appreciate, I'm sure Matt isn't tuning in for the whole
I'm sure Matt
hearing,
isn't,
so
but...
I appreciate that. On to another question. So you've used the term capacity constraints and capacity pressures several times today, but also in many of your statements in the last week. In simple terms, that means that there is too much money chasing too few goods and services. Is this correct? Yes or no?
Yes, it is. But maybe it's helpful to give a concrete example, a micro example of what that might mean to people. Because I think if you just say to people, too much money chasing too few goods and services, it doesn't make a lot of sense. And the example I sometimes give to people is, there's 2 examples. One I often give is when we came out of COVID. I don't know if some people might have noticed, but if you went to get your cup of coffee or you went to a cafe, and people were trying to do that because they hadn't been able to do it for so long, you found that there wasn't enough staff. So there was lots of people trying to get out because they hadn't been able to get out of their houses and spend their money on things that they hadn't been able to spend it on in a while. And they found that there wasn't the ability of the restaurants and the cafes to actually meet that demand because there wasn't enough staff and so on. So that's one example of what you would call capacity constraints. Another one's the construction industry. People often hear, we heard regularly, and I think there's still a bit of this, that there's a shortage of tradies, staff to actually work on. So again, and what happens in those circumstances, as you'd expect, is that because there's lots of demand and the demand can't be met, then the price goes up because those who are supplying it can put the price up because there's just so much demand for it. So it's not a yes/no answer, but I wanted to give you a concrete example of what it means.
Understand. And so I guess in that context, when the federal government increases its own spending, which my EFO confirmed is up by billions in new measures this year, does that add to those capacity pressures and capacity constraints?
If we are at capacity and have got capacity constraints, then anything that adds to aggregate demand adds to those capacity constraints, be it public or private. It's a fact, it's a mathematical fact.
And as the Deputy Chair said, we're seeing the highest spending in 30 years. So, Governor, if the RBA is trying to cool the economy by taking money out of the pockets of mortgage holders and all Australians, but the government is simultaneously heating the economy through high levels of public spending, aren't you and the Treasurer essentially running in opposite directions?
I've said this before, monetary policy is best placed to manage the cycle and fiscal policy is a much longer run concept. It's about what governments and ultimately the electorate and the people judge is important to them. And that is something that goes over a number of years. It's not the cycle. Monetary policy is cyclical. It manages the cycle. So I would say that what we do is, I wouldn't characterise it like that. I'd characterise it as the government and the Parliament are making decisions about what they want to spend their money on, and monetary policy takes those things as given and it manages the cycle appropriate to that. That's the way I'd describe it.
Okay, because what I'm trying to understand is we've literally just seen the quickest change in cycle ever, 6 months. And it very much feels like from everything we've seen and the economic facts, as you've said, is that yourself and the Treasurer and the government are going in completely opposite directions. And is that complete disconnect the reason we have seen the quickest change ever and that Australians are now paying more for their mortgages?
There have been changes within 6 months in the past. It's not usual, but it is not unprecedented. Second point I would make, and I made this point in my opening statement, is that the circumstances changed in the second half of the year, and the circumstances that changed were the world economy, what we judged to be financial conditions, how easy financial conditions were, and the housing market responded, I'd say, quicker than we thought it would. And the third thing is that private demand was stronger than we thought in the second half of the year. They were the three factors that changed the way we thought the economy was going from earlier in the year. For the previous period, we thought we were heading for a situation where inflation was coming back in the band, the unemployment was gradually rising, labour market was easing a bit, but the judgment now is that things have changed and they were the factors we highlighted as having changed.
I appreciate that. I know you've referenced global factors a lot, but globally we're the only economy comparable with any of our other comparable economies that are raising interest rates and having inflation at this higher level. So why are we so disconnected? This is a domestic unique factor and we're trying to understand, and the Australian people want to understand, is the error here from the RBA or is the government causing this, or is it both?
Forecasts are inherently uncertain, and we do the best we can with the facts we've got, and we forecast forward to decide what we think that means for the outlook. And what I'm saying is that our outlook for the economy changed between the first half of this year and towards sort of September, October, November. We were seeing signs that the world economy was stronger, that financial conditions were a bit easier than we thought, and that domestic demand was stronger than we initially thought. In particular, consumption and investment were stronger than we thought. Those were the factors that drove us to change. The facts changed. We had to re-look at our outcomes and our outlook and decide whether or not it was appropriate. Were financial conditions going to put enough downward pressure on inflation? That is the process we went through in getting to where we got to today.
Appreciate that. Well, given the facts have changed, it would be nice if the Treasurer changed his actions, but I understand you can't comment on that. One last question just on energy prices, and I just want to look at the forecast 0.5% increase to headline inflation for mid this year. Now, you've attributed this to the roll-off of government electricity price rebates. As these temporary taxpayer-funded subsidies begin to roll off, our forecast inflation has increased. Were these taxpayer-funded electricity rebates ever a sustainable way to manage inflation, or was it simply a band-aid fix that has now fallen off?
It was a government policy, and I'm not going to comment on government policy. All I would say is that we always knew that the way subsidies would work is they would bring the headline inflation rate down when they were implemented, and that in reverse they would make inflation higher on the way up. That's why through this whole process we have always focused on underlying inflation to try and abstract from those things. So it has made the headline inflation rates very volatile, but our target is headline inflation, but our focus has always been on underlying because we understood that that was what was the most important thing for understanding the underlying pulse of inflation.
Fantastic. Thank you, Governor. Appreciate your time.
Okay, thanks for that, Mr Violi. Can you just read out the order of that, how to vote you've got posted on the office there, just so I can get in touch with Matt for you?
That's my first one. Vote 1, Violi.
Excellent.
One nation second, obviously.
now. Okay, we're going to, without overlooking the role of caffeination, we'll go for a break for 10 minutes. If we... or 15, I think we've got for the break, and then come back 11:05, and I'll hand to the member for Reid for questions. Thank you.
Thank you.
that, everyone. What I'll do now is hand over to the member for Reid.
Thanks very much, Governor. It's good to see you again. Yeah, you too. And I know and completely understand your reticence in making any judgment calls on decisions by the Parliament. But I just wanted to ask you, there's been a lot of discussion around deficit and the impact that that has on the economy. My question relates to, at the last election, there was a choice there between two offerings. Arguably, one of the offerings was potentially going to lead to larger deficits with a nuclear energy policy, lunches for bosses policy. If we were to have gone down that road with potentially larger deficits, what would have been the impact on the economy?
Oh, look, I wouldn't like to speculate about hypotheticals, I'm sorry. You can't think about things in isolation. You'd have to think about what else was going on in the economy at the same time, what was going on with private demand, so where the expenditure was. So I wouldn't like to enter into any speculation about what potentially might have been the outcomes. Ideal in what I'm facing now and what I think is going forward, that's my focus.
Fair enough. When we spoke last time, one of the areas where you thought there were opportunities in private investment that you saw as some real green shoots was in renewable energy projects. I wonder if you might comment on where you're seeing some of that investment grow at the moment.
Well, again, I'm only going by the data here. I'm not an expert in this, green energy, and I'm certainly not an expert in the sorts of policies that should be addressing that. That's for others to get into. I think there were, what we have been seeing, and again, I'm going to defer to Sarah, but I think we have seen some investment. So we talked about data centres, but I think there was also a sense in the investment numbers that some of the green energy investments are coming to bear as well. So that's my understanding, but I don't know if you have anything to add, Sarah.
Yes, so the Governor's right. There are two areas where we hear reports from businesses of additional new investment coming online, and where we actually got some evidence of that in the data is in the data centres that we talked about earlier on, and in some of the renewable energy transition projects as well. So both categories very big and very lumpy. Which means that you can get volatility in the investment numbers. You can get a big thing in one quarter and then you don't see it again the next because it's choppy. But yes, that's right. We're hearing from firms that they are investing in those two areas.
Productivity has been a big focus of the discussions here, as it is a big focus for so many across the country. Can you talk us through how long this productivity challenge has been in Australia? I guess my question relates to just how big is the challenge? How long has it been running?
I'm going to make a couple of comments, and I don't know, Andrew, you might have some thoughts on this. So first thing to note is that growth in productivity has been declining over decades, not just in Australia, but in many other countries. The US has been a bit of an outlier recently, but most other countries have seen declines in the growth in productivity over time. Our productivity probably is where it was at in 2016, something like. It's gone all over the place, so you can't really look at quarterly changes in productivity. You've got to think about it sort of in a more long-run sense. Basically, it hasn't really grown very much in the last decade, probably, in Australia, if at all. I might throw to Andrew because just to make a few remarks about, the world and productivity sort of in the world context.
Yes, I mean, I obviously come from the UK where productivity growth is also extremely weak. The causes of that may be somewhat different. The choice to cut off from Europe in terms of trade is probably part of that story. It is interesting that whilst each individual country has its own stories as to why productivity growth may be low, it's actually a common trend across many countries. The US is apparently the odd one out. We'll see if that proves to be true once the AI process has worked through. But it is a shared challenge. And to your question very directly, how long has it been here? It's been here a good while. And any of the policy changes that might be made or any of the broader steps that the private sector might take as well are likely to take years rather than months, possibly even decades to play through. It's why policy towards productivity needs to be very strongly forward-looking because the changes that take place often take an extraordinary amount of time. There's a famous economic paper, actually, which years after, decades after, the move to better computers took place, said, well, you can see the IT revolution everywhere except the macroeconomic data. It just takes a very long time for factories and for businesses to adjust their processes to take advantage of new technology. AI is a great example. I don't know how many, what's it called, AI slop, or whatever it's called, that you might be getting in your inbox at the moment. We're all thrashing around trying to work out how to make AI work for our organisations. Some people have already managed to work that out. Many are still struggling. So it takes a long time. That's why you have to get going.
And maybe just to add a little bit more colour to that, as a small open economy, most of the productivity improvements that we see coming through in an economy like Australia are from adopting technologies that might have been developed somewhere else. AI is a great example. We've obviously not domestically developed that technology, but we have access to it. We can incorporate it into our businesses. As Andrew says, that's going to take some time, though, for us to all learn how to use it and to get the most out of it, and to not let it degrade the quality of the work that we do, to his comment on AI slop. That's not to say that there aren't parts of the economy that are world-leading here in Australia. There are. With our mining sector, our agricultural industries, there's parts of high-tech manufacturing and the service sector as well. But the majority of the productivity gains that we can generate in Australia will come from adopting technologies that have been developed elsewhere, which is, so we're small and we're open, but the open part of that is really important. But it does take time, therefore, for them to germinate and be developed somewhere else, for them to come here, and then for us to work out how to use them. That's why you're talking years and years, decades, really, to see the full impact.
There's a famous quote from Paul Krugman that productivity isn't everything, but it's almost everything in the medium term, and Australia is a great example of that.
You've managed to get Bob Solo and Krugman in the same. Very well done.
He's very good like that.
So I appreciate the points around private investment in technology and AI having productivity gains kind of down the track. And then similarly, the points that you were making around government policy settings having productivity pay off down the track as well. I just wanted to draw you to a particular capacity constraint that seems to come up so often is around labour and skills. Do you think there is a role then for government to be investing in our people, skilling them up, and would a policy that we have in place around providing TAFE free for people who are going to go work in critical skill shortage areas to train them up in areas like construction, would that have payoff down the track for improving productivity in construction?
With regard to specific policies, the bank doesn't, I don't think, have views on specific policies. We do a lot of work on productivity at an aggregate level to understand the growth potential of the economy and what that might mean for inflation. But with respect to particular policies, I don't think we have any comparative advantage in that at all. I would say, though, that when you look at what's on the Productivity Commission's website in terms of the sorts of things that they see, and they're the experts in this, those educational things, TAFE, university, making sure that we skill our, they're the sorts of things that they're highlighting as something that would be good for improving productivity. So I would be very happy to take the Productivity Commission's word for the sorts of things they think are important.
What I would say, if I may just add, is that the skills that are increasingly going to be needed are right at the top end of the distribution. So, as you probably know, a lot of debate about how the mining industry in Australia is going to move forward into new minerals and so forth. The processes involved with processing those minerals and getting them to a state where they can be sold directly to manufacturers are very sophisticated. And when you talk to some of the companies, as I'm sure you do, or colleagues in front of me do, in Western Australia in particular, and you ask them, well, look, can you get hold of those very advanced mineral skills locally? The answer is often no. And putting those teams together involves going out to the global economy and picking the very best. So Australia's wealth and its sophistication is a great positive for the country, but it does also mean that the kinds of skills we're increasingly going to need are not just sort of here, they're right up at the top of the distribution, which is a great challenge to have, but it does mean that any upskilling exercises have to be focused at that top end.
It does go to a more general point, which is that technology, as history shows you, the structure of the labour market changes, and there are people that will find their skills aren't needed anymore, and there's a whole lot of skills that will be needed, and the economy's got to adjust to that. And it does ultimately adjust, but there are short-term pain sometimes.
Okay, thank you. We'll hand over to the member for Bowman and then the member for Moreton. So, member for Bowman.
Thank you, Chair. Governor, was the cycle that just finished the shortest easing cycle on the record?
It probably might be. I haven't actually done that calculation, but it was about a 9-month easing cycle. Remember, though, that we always said we didn't go as high as other people, so we potentially didn't have as far to come down as other countries. So it's relative to it's relevant, the approach we took, which was not to push interest rates as high as others.
Would the fact that the cycle ran for such a short period of time, potentially a record short period, does that not point to an error?
I think it points to the fact that we have managed to get the economy into a reasonably good place, and we always thought it would be tricky when we were sort of in a neutral position. We didn't know whether we were tight or loose or so on. So I think it reflects the fact that we've been trying very hard to bring the economy down on a soft landing. It would have been very easy to bring the economy to its knees. That would have been very easy, just increase interest rates a long way. We tried not to do that. So I think what it points to is, and as I said earlier, actually, it's pretty good. The labour market is in a good position. Inflation is higher than it should be, but it's still not really high. We want it to come down into below 3 and towards 2.5, but it's not a disaster at the moment.
Michelle?
Yeah, Chris. Yeah.
I'll just add that if you look at the time series of our cash rate, you can see periods in the past where we've been holding at a lower rate than in the past for a relatively short period of time because circumstances changed, just like this time. And after the GFC, when we provided a lot of stimulus, when the world economy was heading south, we held only for a short while at those very, very low rates before moving higher because China surprised us. So again, external surprises can cause you to change direction, and that's what happened back just after the GFC when China was stimulating its economy so much, terms of trade were taking off.
Hindsight's obviously 2020, but would you say that you were premature in initiating an easing cycle last year?
No, I wouldn't say that at all. Based on the information and based on the outlook, we thought we were restrictive, and all the information was suggesting that that was exactly what we were. We were seeing consumption was pretty anaemic. We were seeing inflation come back down into the band. So I think it was entirely appropriate.
Okay. You mentioned that you, I think it was to Mr Kennedy's question, that you speak to the Treasurer potentially once a month, sometimes in person, sometimes on the phone. do you discuss the economic situation and the factors that may play into the direction of monetary policy?
I discuss a number of things with the Treasurer. I usually discuss the economic situation, how we're seeing it. I tell him how we are seeing things. But we would discuss a variety of things. We would often discuss the review. Where are we at with the review? I would usually update him on things to do with the building, the cash distribution system, the payment system. It covers a wide range of things. But yes, we talk about our own view about the economy.
Do you discuss the impact of government spending on inflation?
I don't tell the Treasurer what to do with government spending. As I said, I give him our outlook.
Do you not think, I mean, I'm just looking at it from the perspective of my constituents who've, will be receiving increases in their interest rates, and I'm just wondering, would it would make sense to them that the Treasurer and the Reserve Bank Governor would be in discussion about inflation and about the policy settings that would limit growth in inflation? We
do. We talk about what we are doing to try, the Reserve Bank is doing to try and keep inflation low. That's within our power. And as I've said earlier, we can use that in a cyclical sense, monetary policy, and that's what we're doing.
Okay. Can you explain to me the process of drafting the statement on monetary policy? Obviously, it's a big document, and it's produced pretty quickly from the point where decisions are made. How much of it is drafted in advance? How many changes are made in the course of the day?
Sorry, the statement on monetary policy or the press statement?
Both. But I was asking in particularly the bigger document.
The bigger document. Okay, Sarah, why don't you describe how we
answer that question? I mean, it's clearly we don't write it in between the decision being taken and the announcement. It's drafted well in advance. The content within it is provided to board members as board papers.
Okay.
And then this document, which is obviously formatted in this way for public consumption, is published at 2:30 at the same time that the press statement is handed down. So this document is a bank document. It reflects the view of bank staff. A number of people contribute to it, as you can imagine. Dozens of people will work on this document. But it's provided to the board as board papers, and then it gets published at 2:30 with the statement.
I'm assuming the board may make changes to it.
It's a bank publication. It's not a board publication.
It's not a board publication.
The overview at the start, which summarises the board's thinking, will of course depend on what the board decides to do.
The overview gets amended because it says
obviously it needs to be amended.
And we don't know that in advance, so that clearly has to be done after the decision is taken.
Right.
Yeah. I do find it strange that, 57 pages, that there's very little reference at all to government expenditure. I think there was one passing reference to it, and we've obviously reached the point today where we've established the importance of that on inflation. Is it something that you think should be worthy of further discussion within the statement?
So the statement, the two references that you'll see to government spending in the current statement, there's one in current economic conditions. It's within the section that's discussing demand conditions in the economy, and so it's one section. Obviously, all of the major components get their own section in there, and you'll see it in there. I think we actually had a question earlier on that referred to the chart that you can find in that section. And then in the context of the forecast, you'll find it in the Outlook chapter. We talk about in there the major drivers of demand, and you can see it in the numbers that are at the back of that chapter. But we don't treat it particularly differently to other components of demand. So it sits in the domestic demand section because it's a component of domestic demand.
It's an interesting question what the answer to your question would be if you look globally at other central banks as well. I can speak best for the Bank of England. The vast majority of the time you would not have seen much more in their own documents as well. It is a conditioning assumption. We take what we are told the government intends to do as an input. We don't comment on it, we take it as an input. The only time that changes, and as a veteran of a couple of crises, unfortunately, in the UK, is when the government, debt stock, for example, is unsustainable. And that then poses quite material challenges to monetary policy. A number of other countries have had that experience as well, mostly not in the developed world. At that point, central banks, I think, find it hard, to only devote half a page to it. But the majority of the time, for the reasons the Governor has described, we take fiscal decisions as given, and we then judge what the rest of the economy will do as a result. There isn't much analysis to be done in candidly.
Given what we saw with MyEFO, and speaking more generally, I just think it's probably become a bit of a growing trend that numbers that we've seen as forecasts within budget papers have been way off in a number of areas. Does it worry you at all taking those numbers as read and not, is there risk involved in your forecasts if you are taking what Treasury has said as gospel?
No, we don't. We add our own judgment. I'll let Sarah comment on this, but we don't. We take Treasury's numbers as a starting point, and then we work with some of our own judgment over that, given what's happened historically in terms of outcomes relative to forecasts. So we don't just take them as gospel, but I don't know if there's anything else to add.
Yeah, I mean, I can add just a bit more colour so that it's really clear how we take these numbers. So sort of the start of the process, if you like, is to take the latest publications from federal government, from federal treasury, from the state treasuries as well. So at the moment for these forecasts, that was the MyEFO statements that we had, and we had all of those ahead of time. We take those numbers are published on an annual basis, and they do a different aggregation to what we need to go into our national accounts framework, which is that's the framework we use for demand in the economy. So we have to do a process which goes from annual to quarterly. We have to go through a process that takes those annual numbers and spreads the spending out, not only through the year but over time as well. If we're thinking about, say, a big lumpy investment project, when that will actually get done can be a bit lumpy, as you can imagine. And then, as Michelle's just alluded to, we also look at how those forecasts have played out relative to actual spending historically. So we call these realisation ratios, but we effectively apply those to the budget numbers as well. So the numbers are the starting point that we get from the federal and state treasuries. They're not the end point. There's an awful lot of work that goes in the background. And just a final comment on what you'll see in the latest numbers. If you look at the November statement, so our previous forecast compared to our current forecast, and you look at that public demand growth rate profile that we have, it's really not changed very much at all. Little, 0.1s and 0.2 adjustments. These are small, actually. So we haven't been surprised in an aggregate sense by the MyEFO statements relative to what we knew in November, which was built off the budgets from the federal and the state governments.
Okay, I'm running out of time, but if I can just get
last question.
Last one, thank you, Chair.
I got the approach of benevolent dictator as Chair. But
I'll just keep going until you stop me. So,
last question.
Your underlying CPI growth, you're obviously not expecting it to reach the preferred target until mid-next year, but on a scale of 1 to 10 perhaps, how confident are you of that forecast?
I'm happy to answer that one. I mean, I've been doing forecasting for an awfully long time. I've done forecasting for my entire professional career, in fact. I'm never... Thank you for that. We're never even close to a 10. Things change. Things can change very rapidly. That's what we've seen in the last 6 months. Things can change even more rapidly than that, which is what happened in early 2020 with COVID. Pretty much everyone's forecast in 2019 got completely blown out of the water. So things change. We're very conscious of that. I'd like to say that we're humble and we're always trying to learn. But this is our view at the moment, given what we know today. It is an upward revision from November. It's certainly a stronger profile than we had in the middle of last year. But we'll be looking at things very closely, and we're learning all the time, and we're always trying to get better, but we're not perfect by any stretch, so it's nowhere near a 10.
I mean, we actually answer your question in the chart, and I can tell you that there's a 70% chance that by the end of the forecast,
on average,
trim mean inflation will lie between 1.5% and 3.5%, with a 70% chance. So that's an index of the point the Governor makes.
And that's those fan charts reflect historical errors. So the further out you go, the less certain it gets. So.
Okay. Over to you, Member for Moreton.
Thank you, Chair. And It's good to see everyone. Thanks for coming in again. This week, legislation passed in the Parliament basically expanding regulation in the digital asset space. So I thought it was a timely moment to ask about Project Acacia. I know that the RBA has been doing a bunch of work with the Digital Finance Research Centre. And so I wanted to ask, how is that project going? Where's it up to? What do you see as its outcomes and next steps, given that it's in that digital assets space?
I'm going to pass to Mr. Project Acacia.
Thanks for the question. What Project Acacia really represents is a down payment on a program of work where we're trying to think about how might the financial system look in 10 or 20 years' time? And so this is just a small step on that journey. What we're particularly focused on at the moment is the question of opportunities to uplift the efficiency and the functionality, innovation in our wholesale financial markets. What we've heard from industry is where they see the biggest scope for potential efficiency gains is in the fixed income markets. So we have about 22 use cases currently as part of that project. There's a broad church of participants from the largest banks to small fintechs, which I think has enriched our learning about where the blockages in the innovation ecosystem are in Australia. So we're very open-minded about what precise innovations, whether it be in financial market infrastructure or in forms of money, are going to get us to that end state of a more efficient, more resilient, more innovative system. As I said, fixed income's been the major focus. Cross-border, looking ahead, will also almost certainly feature in subsequent work. In terms of the timeframes, we'll have a report published in April, and that report will not just do a stock take of what we've learnt with industry and with our fellow regulators, but also give a sense of where we see the key priorities going forward, and there'll be buckets of recommendations there, basically things that we think we can do at the RBA to facilitate responsible innovation. There'll be recommendations for the broader regulatory community, so the other agencies, and then there'll be recommendations for industry, because if we're really going to see a substantive uplift in the efficiency and functionality of our financial system, it really will require all shoulders to the wheel. So the report will document where we see the blockages and some potential solutions to help us get to a better place.
And so understanding the timeframes you're talking about, bringing in recommendations for other regulators, how do you expect the industry to start adopting tokenisation in wholesale markets?
Where we're seeing the most activity globally is in the US, particularly in the US fixed income markets. We're looking at that experience very closely. We're also observing very closely what other central banks and other regulators are doing. Pay close attention to the work in tokenisation in places like Switzerland, Hong Kong, the UK, and all of that is going to inform both how we structure up our work program internally at the bank, but also our recommendations for other regulators. A key point, without going into forerunning that final report too much, one very clear message we have heard from industry is that what they're really looking for is a path to commercialisation that doesn't currently exist. And so we are thinking very hard about what type of sandbox arrangements, for instance, could facilitate responsible innovation, where the regulators and industry can learn and iterate as we go along, to help ideas move from the ideation phase into the commercialisation phase. At the moment, the general sense you get from industry is one of the sandboxes that exists is sort of where innovation goes to die, and so we want to do what we can. Our colleagues at ASIC are looking at that. There's a review of the enhanced regulatory sandbox right now that Treasury has commissioned, so a lot of us are turning our attention to how can we set up a national infrastructure, if you like, to help facilitate responsible innovation in this space.
And understanding that obviously we'll have to wait for the full report and the recommendations, what are the things that you are seeing in terms of the responses from other central banks at the moment? Are there any sort of broad trends that you're seeing from the central banks in other jurisdictions?
Yeah, I think that probably the most consistent one across countries is exploring what forms of tokenisation and digital assets and what form of digital money could be required to harness and yield the biggest efficiency gains. I can't really think of a major advanced economy central bank that's not doing work on the tokenisation of markets. Where things are much more variable across countries is on the retail CBDC side. There I would say that the ECB and the People's Bank of China are way out ahead of everyone else, and they are proceeding down that road for very different reasons, for reasons that don't have a lot of resonance here in Australia. So the retail CBDC research agenda at the bank is sitting behind our work on wholesale, and that's pretty common across central banks globally.
If I may just say, one of the major challenges is that some of the most technologically advanced efforts at tokenisation are actually being developed by individual private sector institutions, JP Morgan, HSBC and other large international banks. They obviously have a commercial interest in their token becoming the standard. Come and play with us, and you can have tokenised. And this so-called walled garden effect, whereby you have multiple rival tokenised deposits or other forms of instrument, has some merits perhaps in terms of driving innovation, but also potentially could undermine the commonality of value across individual currencies, which is obviously one of our core objectives. So that tension, I think, Brad, between the innovative spirit of the private sector, which is a good thing, versus the potential commercial interest in not standardising is a very strong tension in many countries. And if you were to ask me, and Brad may have a different view, that's part of being open and dynamic, is actually a lot of the real energy is going into that walled garden world. And it's part of our job, therefore, with work like Acacia, to try and think about how we make sure that it doesn't just become a free-for-all.
Well, thank you, and thank you, Mr. Acacia, Dr. Acacia.
It's not bad.
While we're talking about new technology and changes within the financial system, I also wanted to quickly ask about CHESS. Obviously ASX is replacing the system, and we've seen that a previous program of that was scrapped. That's due to deliver its first release in the first half of this year. So, Governor, I wanted to ask you, what's the RBA's role in supervising that and making sure that it gets the outcomes that everyone's seeking?
So again, I'll make a few remarks and I'll pass to Brad. We obviously have taken a very keen interest in this. At the moment, our focus is on making sure that what is being delivered is going to meet the needs of the market. And also, given the challenges we've had with current CHESS, so current CHESS is decades old, it's being maintained, but there have been problems with it. And so part of our supervisory effort is to make sure that the sorts of issues, operational issues that have arisen in that environment will not arise in the new CHESS environment. So that's part of it. But this is a multi-year project for them. This is just the first step that they're going to introduce this year. And then there's, I think there's a couple of years, isn't there, Brad, before the next sort of phases come in? Yeah.
Be layered in over a period of years. But maybe I could just make one broad point. It actually relates to the earlier discussion about digital assets. we're not in the business of telling industry what technology they should build or implement or operate. What we are in the business of is ensuring and interrogating that whatever technological solutions industry come up with, that they're not going to compromise what we care most about at the bank, which is financial stability. So that's where our focus is very squarely trained on, ensuring that whatever technical solutions ASX arrive at, that the concept of operational resilience is hardwired into the system right from the outset. That's really our central focus. Of course, our colleagues at ASIC have a complementary remit as it relates to conduct, fair and efficient markets and so on, but our focus with CHESS and the ASX is very much ensuring that whatever technology they introduce does not compromise financial stability.
So, and given that's your focus at the moment, surely the largest point of risk is at the point of changeover, and I'm keen to know what the RBA is doing to make sure that risk is managed through the changeover and how industry is going to get ready so that that smooth transition happens.
Well, we can't do that for the ASX. What we can do is make sure they have processes and governance around that, and that would be our focus. ASX itself and the industry has to manage that whole process, that whole operational process, and part of that is making sure that that ASX has appropriate forums for engaging with industry, that they have appropriate sort of checklists for just like we do in our own operations. When you're changing things over, you have to make sure you've got all your ducks in a row, that you've got a fallback procedure if things don't work properly. These are the sorts of things we'll be making sure ASX have in place, but the actual implementation of it is them and the industry.
I understand that you provide a supervisory role, and the last question I was going to ask, Chair, is essentially where are you up to in those preparations for that supervisory role, making sure those processes and procedures are in place so it goes smoothly.
Brad, did you want to comment?
Yeah, I mean, it's ongoing. The teams are meeting all the time with ASX and ensuring that there's sufficient challenge, and as the Governor said, most importantly, making sure that there is sufficient oversight, governance, challenge going on within the ASX and with ASX and industry. So that work is ongoing, and it will extend over a multi-year period because the transition will extend out to 2029.
The other focus for us is because of that long transition period, ASX has to make sure that the current CHESS continues operating and is resilient. And it's proved sometimes not so resilient, and they have got issues with it. So have they got the resources devoted to its upkeep? Are they investing appropriately in it? Because they've got to keep it going until this multi-year process of moving to a new system finishes. So that's also a very big part of the oversight effort we've got.
Okay, thank you, Chair.
Yeah, it was a pity, before I hand over to the member for Deegan, they were looking to utilise blockchain as a platform, and obviously that spectacularly fell over, but it would have been an interesting transition to that technology. Yes, no?
Yeah, they, well, that's right. They were a very early uptake attempt to implement that. They were very early on.
Yeah.
And it just didn't work out.
Yeah.
So they've had to go back to more traditional technology, I think.
I will tell you, Australia caught international attention when that happened. I remember working on all of these issues in the UK when we were rebuilding our own version of RITS. And when the news was announced that ASX would be adopting blockchain technology, it really gripped people's attention. And there was a general thought, we're way behind the curve. The Australians must have some deep insight. I can remember that feeling very strongly. So that was a while ago.
Turned out not to be the case.
But we can't be pro-digital asset and not work out another use
need
case.
to do it.
It's good to be a fast follower sometimes. I think that's what the management consultants say.
Yes, indeed. Member for Deakin, you've been exceptionally patient, so over to you.
Thank you very much, Chair. On Tuesday, pretty much every mortgager in Deakin and around Australia received that unwelcome message that their repayments are going up. Far fewer young people saving for a deposit, self-funded retirees received a message saying that they were going to get more interest on their savings and deposits. If you could briefly say why you think that two-speed approach has been so evident across so many institutions. When I looked this morning, several of the major banks and institutions had not at all increased interest.
You're asking about why they react on lending
at rapid
rates
pace when it comes to
rather
charging
than
us more
deposit
interest and
rates.
doing a go slow when it comes to paying us interest.
Yes, well, it's ever thus, it would seem, with the banks. I mean, it's up to them to decide how they want to manage it. The thing is that it's very visible on the mortgage side, and they pass it on quite quickly. Often they've passed the ups on more quickly than the downs, although in recent times I think because there's been elevated competition, they have in fact been quite reactive on the downside. On the deposit side, I think it's just because it takes people a bit longer to think, I can get a better interest rate elsewhere. So it will come through, and you do see evidence that as time goes, deposit interest rates rise as well. But I think it's just the behaviour of people. It takes them time to sit back and think, well, I'm earning this. That bank over there is offering a bit more. I think I might switch. So I just think it takes time.
So they're doing it because they can get away with it?
They're doing it because then they don't have to react immediately. Chris, do you have anything to add on that?
I think the underlying issue here is competitive pressures, and they're a little bit more stark maybe on the mortgage side at the moment, including because there's quite a lot of brokers who help people really understand very quickly how to get a better deal on their mortgage. And there's a lot of non-bank competition in that space. In the deposit payment space, there's much less of that, and I think that's the difference in terms of the competitive pressures.
You have seen some banks, one bank in particular, I won't name it, exploiting that fact, however, and entering into that deposit market and competing quite aggressively in the context of forcing rate rises to go through as quickly as rate cuts, as the Governor and Chris say. That's probably the best thing that could be happening.
I mean, it's again comes back to people are always encouraged to look around for the best deal in mortgages, look around for the best deal on deposit rates as well. You know, don't just sit there. But people sometimes are a bit prone to inertia.
So one of the things that a change in interest rates is trying to do is influence behaviour. And would it be fair to say one of those behaviours we're trying to encourage is saving?
Well, it is, and this comes to a point that often gets missed, and we've made this point a number of times. The transmission of monetary policy, everyone focuses on what we call the cash flow channel, which typically is about how do you influence the amount of spare cash that people with loans have. But that's actually not probably the most important channel. There's two others. One is this channel you're referring to, which we call the intertemporal channel, which is higher interest rates are, then the more people are encouraged to save now and consume later. So that sort of dampens demand. And then the second channel is the exchange rate channel. Because as the exchange rate rises, it makes import prices cheaper, it encourages people to holiday offshore and buy foreign goods. So, you know, there's these other channels as well which are impacting. It's not just this cash flow channel, which is often the one that gets the most focus.
So when banks are taking the go slow when it comes to passing on those benefits to deposit holders, they're kind of, you know, whether not necessarily out of malice, but certainly not accidentally hindering the benefit or any good that can come from an interest rate rise.
Yes, but the impact of interest rate rises happens slowly anyway. I mean, our judgment is that the impact of interest rate rises or declines, for that matter, often happens 12 to 18 months down the track. There's some immediate reaction, but so I wouldn't say that in the scheme of things that it's really impeding things.
So the message has been shop around quickly, because we can't just take for granted that the swings and roundabouts are going to be passed on in a beneficial way.
Well, I think, you know, they will get, it does all ultimately work. You know, you see that as interest rates come down, deposit rates and loan rates come down, and not necessarily one for one with each other, and the same when it goes up. So it does work. When we move the cash rate, it changes bank funding conditions, and then it is passed on through deposit rates and lending rates.
Thank you. With the recent technical outage at the RBA, I think it was talking about operational stability was kind of the focus.
Yes.
I've taken from that language that it was not so much an issue of an external kind of difficulty, but it's the reliability of the system. I know you're going to release the analysis soon, but nothing nefarious, just a technological problem?
No, it was nothing nefarious. It was a technological problem, and I'm not an expert in this, but it was to do with expiring certificates, apparently, which caused a problem. You know, it's very unfortunate. As I said in my opening remarks, we apologise for that. It is not acceptable, and we do have to lift our game, just as we, as the supervisor of ASX, expect ASX to lift its game. You know, I'm adamant that we need to lift our game, and we understand that. We have a big program of work going on to lift our game in this area. This was a very unfortunate incident which had big flow-on effects, but it didn't impact the bulk of payments. It didn't impact the real-time payments. It impacted the batch settlements, but they're the ones that often affect people because they're the payrolls, they're the welfare payments, they're the property settlements. So that's why it was so unfortunate and not acceptable. We're determined that we will release the report.
Thank you, Governor. I'll leave my questions there, Chair.
Oh, okay, very good. Very efficient too. Over to the member for Brisbane. That's very good of you.
Thank you, Governor, and everybody for being here. Really do appreciate it. I'm going to change tack a little bit and ask questions about workforce equality and closing the gender gap. And I know, Governor, you've spoken about this in relation to your experience and the importance of workforce equality and the gender pay gap on economic growth. But before I actually ask my question, I do want to offer my support for something you said last year when you said that you hope taking on the role as the first female Reserve Bank Governor gives encouragement to women. And I hope so too, that's for sure. But in relation to my specific question, why is fixing the gender pay gap and workforce equality good for the economy? And I'm thinking about, like, what are the economic factors that you monitor, that the bank monitors, that could get impacted with improvements that may come with improving gender equality? And I'm thinking workforce equality and, gender pay gap.
Well, it's a very big topic, and it goes broader than gender. It goes to diversity more broadly. What I can say in terms of our institution is that we think that gender equality, diversity more broadly, it's important that we as a public institution represent the people of Australia, and that means cultural diversity, gender diversity, First Nations. You know, it's important. Why is it important? I think the evidence shows, and look, and I'm not an expert in this particular facet of research, but my understanding of the evidence is that it's better for performance. So in companies that are profit-making companies, the evidence is that if you've got more diversity, you tend to make better decisions and profits benefit from that. In our case, it's all about better decisions, and you make better decisions, I think, and I think the evidence shows this, when you have a diversity of opinion, and you get that from things like gender, you get that from things like cultural diversity as well. So I don't know if anyone else has any comments to make.
Just on the how does it show up in the macroeconomic data that we're tracking? I think one of the main ways that we would think about this and incorporate this into our forecast is through the labour force, labour force participation. And so obviously if we're thinking about women's participation in the labour force and the things that can enable that, it's a historical fact that women's participation generally has been lower than men's. It's still a little bit lower than men's today, but what we have seen is that it's increased over time, and that's gone generation by generation as well. So the generation that entered the workforce in the 1980s, fewer women participated then than men, and the gap has sort of been closing, but actually more like since the 1970s. So So for us, we see it coming through in that participation rate. That means more jobs, more employment. That does have a role to play in terms of household income as well. Obviously, people should be making the choices that they want to make, and we're not sort of advocating for one choice over another, but it is an important part of how we understand the economy evolving over time. And in fact, in the last couple of years, we've seen fairly substantial increases in the participation rates. It's fallen back a little bit just recently, but not very much. But part of that has been the long-run trend for more women to be able to work part-time or full-time as they choose.
It goes to the point that, you want the skills from all of your population, not just from a portion of them.
Yeah, and I think you may agree or disagree, but I think therefore it's fair that, everything that we can do to support bringing out, making sure everyone in our economy who wants to participate is participating with the skills and that we actually need for growth, and that is particularly important for women who have fallen behind at the moment. That's how I look at it. What's the bank doing itself in terms of addressing, workforce equality and gender pay gap in the bank?
So we have done a number of things. We do have a gender pay gap. It is basically driven by the fact that the more higher paid and senior roles and a lot of the overtime tends to be predominantly males.
Yeah.
So what have we done? We set a target for women in leadership and a number of years back of 40%, and we've achieved that and we continue to achieve that. Our target is 40% in leadership, 40% women, 40% men and 20% any gender. Our overall workforce is about 43% women and the rest men. And if you look at the skew, it tends to be that the women tend to be in the lower paying roles and the men tend to, notwithstanding our 40% leadership, that tends to be the case. We don't, so what are we doing to address that? Obviously we've got targets. We are looking for instances of where there looks to be equal pay, people doing the same job with similar experience, similar skills, and they're not being paid quite the same. So we're looking for instances where we might be able to address those. But the bigger issue for us is just this issue, as I said, that we need to get more women into these higher paying roles, and that takes time. Yep. So that's our focus.
I appreciate it does take time, and it's not a problem that's unique to the Reserve Bank, that's for sure. If I could just switch gears a little bit. Earlier, I think it was Mr Hauser who talked about the importance, or it might be the other gentleman, of resilience being embedded in the operations of the bank. And so I want to go back quickly to scams and the scam prevention framework. And I understand that the bank doesn't regulate consumer issues, but scams do pose a threat to financial stability, and the RBA does engage in payments, which obviously can be subject to scams. In fact, actually, I think I understand also that confirmation of payments is not offered at the bank as well. So with all of that, my question is, how are you progressing your preparedness for the introduction of the scams prevention framework, and are there plans to consider confirmation of payment or other activities that will continue to increase the resilience and security of the payment system?
We're not like other financial institutions, obviously. Our main, we receive payments on behalf of government customers and we pay on behalf of government customers. Interestingly, we, in our banking department, for payments to people, so unemployment benefits or family welfare benefits, those sorts of things, a lot of that used to be done by cheque, and there were scams even around those cheque holders. So we have long been alert to that. Now we make electronic payments rather than cheque payments, but we do have processes in place to make sure that we are paying to the right accounts. It's a slightly different context in commercial banks, the scam issues, because that's often people using commercial banks to pay away to other people. They don't have quite as much. I mean, we have, as I said, a fairly narrow remit. We're dealing with one government department and we're making payments to recipients. So, yes, we have processes in place there, but it's a little bit different for us than for commercial banks.
And so just so I'm clear, so does that mean that you don't need that sort of payment confirmation, or you've just got different processes?
Well, so what we do is we take the details from the government departments, including the accounts that they're going to go to, and we pay away. The government departments have to make sure that, so that there's a sort of a secure process there, the communication between the government department and us, and the government departments make sure that the bank account details that they have are the correct bank account details for the people they're paying away to. So that's, and then we make sure that there's, if you like, the security is that people can't get in and alter the file to pay away to the wrong accounts, if you like.
Right.
That's sort of the layman's way I would describe it working.
Okay. I just want to move on quickly also, one more, Chair, if that's okay. Just following on from Jules and the discussion around technology and I call it the evolution of the financial markets, right? We've got digital assets, we've got blockchain, we've got tokenisation, etc. Do you incorporate now that sort of financial technology revolution into your modelling? And and given it's changing, that area is changing so rapidly, like how do you think about that and keep track of it all to bring into the modelling? Because, it can affect, these changes will affect financial market confidence, etc. There's an upside and a downside, so,
Well, I'll leave it to Sarah. The bottom line, I think, is that our models don't really take into account financial innovation in any sort of structured way.
Right, okay.
It's, and to some extent, I don't think we're only developing financial market inputs into our models. But anyway, Sarah can talk more to the models.
Yeah.
But sorry, just before you, but some of that work you're doing is looking out, sorry to jump in.
No, of course.
Is looking at that too, right, though?
Indeed. Yes.
Sorry, Dr. Hunter. I didn't mean to.
I can come back after.
Yeah. Just to be clear, the work that we're doing has a very long-term orientation. The work that we are engaging in with industry and other regulators is really designed to understand how could financial market infrastructure, new forms of money and payments change the financial, really the entire ecosystem. That type of work will resonate over 10, 20 years, I think, in terms of the sort of implications for the financial conditions that might be reflected in the forecast. They're quite distinct programs of work.
So the way we would see that showing up in the macroeconomic data is ultimately as productivity. As Brad said, if you go back decades and decades, when you go back 20, 30 years, we were in the world of cheques before ATMs even. Paying for anything just took longer. I remember going to the post office with my grandma to get her pension every week. She had to queue up for 20 minutes.
Now we can get instant payments, right?
No one does it that way anymore. It's much more efficient. People get the money instantaneously in their account and then they can use it straight away. That's a productivity improvement, and that's where it shows up in the macro data. But to Brad's point, it doesn't really have an impact on a 1 to 2 year horizon, but you'd hope that we would start seeing the benefits from it in maybe 5, 10, 15, 20 years.
Just to give you a sense of potential timeframes we could be talking about, the last epochal change in the financial system was really the dematerialisation of securities. And that process started in the 1970s, accelerated in the 80s and 90s, and really took hold in the 2000s. So who knows how quickly, or actually, if at all, tokenisation is really going to scale, because there are a lot of issues that are still yet to be resolved, and we are stress testing those with some vigour. But that change from the sort of the materialisation of security, paper certificates to electronic forms. That actually took decades to unfold, and so it's possible that even though we are seeing tokenisation take off in some small areas of the financial ecosystem, that it just takes a long time because of the interoperability challenges and a whole host of other issues.
What was the name of that epochal change? That's the ultimate barbecue stopper. What was what did you say it was?
The last epochal change in the financial system was that move from the dematerialisation of securities.
Paper to electronic.
Yeah.
Remember my history better.
Just one point. One of the challenges of being a central banker, unfortunately, is particularly when you're setting monetary policy, the numbers that tend to move the dial are in the hundreds of billions or even the trillions. And so lots of issues that are highly relevant to people in the high street in a micro sense don't show on the radar of monetary policy. If you plot, and you know this probably, if you plot the currency composition of these new assets globally, they're almost all in US dollars. And the project in the US is a little different. I'm not quite sure, actually, we were debating it earlier, where the Trump administration has got to on this. But the thought that it might be possible to generate a large increase in the volumes of US dollar-denominated assets is thought of by some as a means of financing the various deficits in the US more cheaply. Now, if that works, and I'm not sure we've seen the detail on that yet, we may never do, we may, US interest rates may fall somewhat as short-term financing in the US picks up. That is the sort of thing. So if you're a US policymaker and you thought that this project actually was getting off the ground, which I don't think it has yet, that might move the dial for the Federal Reserve. We're a long, long, long way from numbers of that scale in Australia. We may never see it. We're certainly not seeing it at the moment.
Thank you.
Terrific. Okay, so the way we're going to close at 12:30, obviously. I'm going to come back to questions for the committee members, myself and then the Deputy Chair, and then I'll call on people if they've got a quick question. Just around obviously artificial intelligence has been referred to a number of times through today's discussion, and obviously it's being talked about quite a lot. I'm actually interested in knowing how the bank is utilising this. How are you using machine learning, artificial intelligence or advanced data tools in your core functions? Where are you seeing improvements if you are using it, and how those tools complement expert judgment? And also how those technologies are potentially improving the bank's visibility over things that you're tracking, from household spending to business conditions.
Sure.
Are you able to offer some insights there, please?
Sure. So I'd have to say that we're not as advanced as particularly some commercial entities in this space, but I'd have to say central banks around the world are probably, we're conscious of risk and we want to be cautious about how we're adopting it. But there's a couple of things. The first is how can we use AI to address our processing, make our processing more efficient, do things in a more efficient way, give people back time from processes that might be taking up their time, and they can do them more quickly using AI. So there's that sort of approach. And then the second thing is how can it help us in our policy processes, information. So examples in the first, and look, I'll open it up and people can give examples, I think, but examples in the first block are things like coding. So we have a lot of coders in the bank, people in the policy areas who do coding for policy purposes. That sort of thing is, we've opened up that, so that's, people are using in those circumstances. People are using it in some of our support areas to try and find ways to do things more quickly, automate processes. It's all about making sure that people use it in a way that helps them, but they also conscious of the drawbacks and the potential biases and also potential errors. Andrew referred to AI slop. Some people are saying, well, I'm getting stuff in my inbox and it's clearly written by AI and it's just annoying. Thank you very much. So we've got to find a way, people have got to experiment, but at the same time, how do you make it useful in your processes? On the policy side, we have some people who are working hard on AI techniques to utilise our wealth of internal information more effectively. So we have one just simple example. We have 22 years of liaison notes.
That's what I was thinking, yep.
How do we
Not on
use
liaison, but I was thinking about all that data that the RBA possesses.
Yeah. How do we use AI to quickly harness some potential insights from that stuff, and rather than people having to go through and open every single note and take and we've had a lot of progress there. So I think we've got a little program that actually allows us to do that. You can go into the liaison notes and say, draw me the insights over the last 22 years from X. So they're two examples. I don't know does anyone else have any examples they want to highlight?
Just to
And also in answering it, could you?
Yeah.
I'm very grateful. Sorry, I have had a terrible run in interrupting you, Dr. Hunter, and I'll make up for this at some point. But on those 2 points about the way you use it on a daily basis and a policy basis, is it organic or is it a structured program that you're using to start using AI more within the bank?
We have a policy, we have a governance framework.
That's what I was going to ask too.
We have all those. We're building up all of those guidelines. There are guidelines, so we don't use publicly facing AI, large language models. We have internal process, an internal language model, if you like. So because we're cautious about a lot of the information that we have, some of it is restricted, so we've got to be quite careful about that. So we have governance and policies around all of that. But we are encouraging people within those guidelines and guardrails to use it and see how it can help them. But did you want to talk about?
Yeah, just to add to the Governor's example of using it on our liaison data. So you actually now the public have access to what we learn from that because it's now incorporated into the liaison box that gets published every quarter in the Statement of Monetary Policy. So that analysis is actually making use of the large language model that we use and we've built. We're calling it Warrior, but it's making use of that technology to draw out those insights. So actually, it might not be obvious, but everyone has access to that, including us. And the other point I would add is particularly thinking about what we get our analysts to do with their time. The fact that they can now do coding and other types of data analytics much more quickly because the technology enables them to do that means they can just do more of it. So we've been exploring, for instance, what can we learn from our forecast errors, which we were talking about earlier on. We're very actively trying to look at where we've been wrong in the past, interrogate that from a lot of different perspectives and learn from that. What can we learn from our previous internal research? So using an LLM that's been built within the bank to really interrogate our internal information so it's secure and we don't have to worry about stuff going up into the cloud and being insecure. But what can we learn from that and make sure that we don't repeat work, repeat efforts, things like that. So we're very active in taking this technology on because we do think it will enable us to do our jobs better.
Do you want to add some
examples? Chair, I'm a huge advocate for AI and enthusiasm counts for a bit as well, and Sarah and others have as well. And we have a very small kind of, I think what Xerox calls skunkworks team of some of our smartest people who do things that they probably don't tell us too much about on safe computers. But one of the things, obviously, with AI, when you get to know it, is what it can't do as well as what it can. Yeah. And a little anecdote, I hope this isn't going to fall the wrong way. So before I came here, I thought I'd ask ChatGPT what members of your committee had said about the RBA and the Australian economy over the past year. And it said it went away. And you were
overwhelmed by all the positive statements.
It went away for some time and came back and said that none of you had said anything. And so I said, well, look, because I'd already done some research and I knew you had, so I said, well, I think it was you actually, you talked about gas, I think, didn't you, on the eastern seaboard. I said, well, Ed Husick did talk about this. And Shaq said, oh yeah, you're right, now that I go and check again, he did mention this. And I said, well, what else have you talked about? And they said, well, there's nothing else. And then I mentioned, I think it was you, Simon, had mentioned something about us, possibly not in the wholly positive way. And it said, oh yeah, well, yeah, Simon said that, but there's nothing else. So it's not meant to be too much of a joke, but it is important, and as people get to know what it can do, is also knowing what it can't yet do. Some of it maybe makes you question whether it's going to be the absolutely dramatic technological epoch-changing thing that Brad mentions. It still has its limitations.
It does, and I think that's part of the thing that in setting up our guidelines, we're trying to make people question. You know, there was an example, I think, of one of your team who asked for a literature review on a particular topic, and it came back with things that didn't even exist. So you've just got to be very...
Okay, thank you very much. A very comprehensive answer. Over to the Deputy Chair.
Great, and great to see you doing all the work in AI and blockchain. I think it's fantastic, and I always find Grok better for economic stuff than ChatGPT. I don't know why, but maybe it's much better with numbers, and
does have some biases, Grok.
Yeah. Well, I hope I haven't been critical of the RBA, but I have been very critical of Treasurer Chalmers, and that's where I'm going to return. Mathematically, earlier, Governor, you said spending affects aggregate demand and aggregate demand affects inflation, or something to that effect. The mid-year economic fiscal outlook shows over the past 2 years that Jim Chalmers' budget has deteriorated by 1.9 percentage points of GDP. Now, 1.8 percentage points of that is due to higher spending. So my question is, all other things being equal, that 1.8 percentage point of additional GDP in government spending, doesn't this put upward pressure on inflation?
Mathematically, if you have a limit on the extent to which demand can go because of supply, if one bit goes up, then it will put pressure, whether that's the public or the private. Mathematically, that is correct.
Great, thank you. Just moving on to another point, your current forecasts assume rate rises. I think based on that, I think it's 1 to 2 rate rises. Inflation won't even hit the midpoint of your target. So again, is it noting all of this is subject to change, noting the inherent uncertainty, but at the moment, just want to check I'm understanding it on that basis. Is it that the RBA forecasts we're going to need at least 1 to 2 rate hikes, if not more, to bring it back to the midpoint?
That's what the central forecast, which as we know is very uncertain, the central forecast suggests that according to our models and our judgment, in order to get that particular inflation outcome, then this is because this is a technical assumption, we just use the market path. If we put that in, this is what pops out. That is what pops out. So we've used our models, we've used our judgment, and we've used the market path. And what that generates in terms of forecasts is, I think, a number of 2.6 by 2028.
Yeah. And look, I respect and appreciate how apolitical the RBA, the full RBA, has stayed. Given government spending is at a 30-year high, though, and the statements, the notes to the monetary policy statement only mentions it once, and given the Treasurer on Tuesday said something like, look, if you look at the Reserve, or not said something like, said exactly, if you look at the Reserve Bank statement today, it doesn't mention government spending. It's not a factor in the decision they took. And I appreciate today you've gone to lengths to say, I don't comment on fiscal policy, I don't comment on the Treasurer's words. I worry this puts pressure on the RBA board, verballing that. Have any of the members of your board expressed to you that they feel pressure from this government?
No, absolutely not. What I can say for myself and the staff at the bank and the board is that we are just focused on delivering inflation back in the target band with as strong an employment market as we can get. That is our focus. We are not pressured by political statements. That is our focus.
Can I add to that? And having seen a couple of other policy boards as well, the pressure we feel is the pressure that comes from not hitting the targets we've been asked to give. That's our credibility. If we cannot tell a clear story about our policy settings and the way that we think they will bring inflation back to target, we're all, and I think rightly actually, open to question by you as delegates of the public as to whether we're doing our job properly. So it's an odd situation where one might say, well, do you know what, I might get a verbal from X, Y, or Z, so maybe I won't do what is directly going to damage our credibility to deliver the goals that we've been set. From time to time, you'll have different pressures upon you, but the thing that really weighs, I will say, on me as a relatively new member of the board and a voting member of the board is the thought that I may not have done what it takes to keep inflation at the target.
And do you see the target as the band, or do you aim for the midpoint?
Well, we're required under our statement on conduct of monetary policy, there's a target band, but we are required to aim at 2.5. So that's the
and
target.
Just to take what you said, Dr. Hauser.
I'm Mr. But yes.
Or Mr. Sorry, upgraded you.
It's important. It's actually.
You sound very impressive. So we've got Dr. Acacia, and we'll have to give you a note. But based on the fact we're not hitting that midpoint, and if that's your goal, even with in the current projections, noting it's all subject to change, we're not even hitting your goal with those forecast rate rises. Does that add to that pressure you're feeling?
Yes, it does. It does. And the board wanted to give the message, and they've been giving this message actually since November and December, that they are uncomfortable. They are uncomfortable with inflation sitting above 3. Now, we don't think it's running away, and the forecasts show that. But if we can get it back, if it's going to take us to 28 to get it back, it's going to be out of band and above target for 6 years.
There was a time when
above target for 6 years.
It went out in 2022, and it'll have been
6 years. It'll be out of target.
2028. And I have to say that prior to COVID,
that's what they're forecasting.
We were outside the band in the other direction for quite a few years, below target. So
if the projections are right, we will have been out of target for 6 years.
I think it'll be 6 years.
If they come to pass, I mean, there's also the question of headline versus underlying inflation, of course, because the target is specified on headline inflation.
Sure.
And last year, actually, headline did sit within the target band for some time. But as the Governor's already talked about, there were temporary measures that were resulting in that. So I'm not trying to move the goalposts, but it does depend a bit on what you look at.
Yes, that does weigh on the board's thinking, and that is part of that is the big reason why they decided to raise the interest rate on Tuesday, because they are not happy with what the inflation rate is at the moment and what the prospects are for getting it back down.
Okay.
Well, thank you very much for what you've all done. I know you've got a lot weighing on your shoulders, and thank you for how you've acquitted yourself and handled yourself today.
Thank you. Now, I'm just conscious with the remaining time we've got left. The member for what I'd like to do would be even-handed. I'll ask the government and the opposition ask one more question. I'm conscious the member for Deakin, you had some spare time and you ceded it. Do you have a follow-up question? Then I'll ask the member for Bowman if he's got a question. And if we've got any extra time, I'll try and open it up.
Sure. So a lot of discussion around inflation today has been around the balance of aggregate demand or total demand and supply capability. We've talked a lot about demand today, but in terms of supply capacity, if I interpret your remarks correctly, the main aim is productivity, which kind of sits more in the fiscal policy portfolio than the more cyclical monetary policy portfolio. So when we talk about government spending, would it be fair to say that it's what it's spent on that really matters? Is it increasing productive capacity? Are we creating, healthier, more trained and skilled workers that can get to where they need to go quickly and things like that? And it's not just as simple as numbers, because government spending kind of contributes to both supply and demand?
Well, yes. I mean, what things are spent on clearly matters. And if you look at some of the Productivity Commission's recommendations for ways to increase productivity, some of them, not all of them, but some of them require not just federal government but state governments to perhaps spend money. So, you know, there's a sense in which some of that matters.
Thank you.
Okay, member for Bowman.
Thank you, Chair. You mentioned the pressure that you feel in trying to reach that inflation target, and that pressure is certainly felt by Australian households as well around inflation. Is the fiscal decisions, is the expenditure decisions that are being made in this building making your job harder?
No, I don't. I think at the moment our focus is simply on what we can do to get inflation down. It's basically a product of the fact at the moment, as I said, that private sector demand and government demand altogether in aggregate demand is too high. That's our focus.
Okay, member for Bennelong, lightning round questions. Member for Bennelong, I know the member for Moreton has a question. I think the member for Brisbane does. If you do them quickly, I think we'll get through, even with maybe with the forbearance of the governor.
My understanding is you use the NPP during COVID for quick payments. I want to sort of get what plans do you have to switch RBA payments from BECS to NPP?
Well, that's actually an ongoing conversation with the industry. NPP payments work really good for fast, if you need to get money out fast. For routine payments, there's a debate about, you know, cost versus benefit of doing that way. So that's a conversation we're having with the industry at the moment. Some payments, for example, regular welfare payments, it might be that they just are better off just continuing to go through a BECS batch-like process, which is cheap.
It's better to have two systems, is that what you're saying?
Well, there is a question that we're asking at the moment. The Reserve Bank's done a risk assessment on this, and we think the industry hasn't thought out thoroughly the implications of completely getting rid of a system and making sure that there's enough resilience, because if you're just relying on one system and it goes down, then what happens to all the payments that are necessary for welfare payments, child support payments, those sorts of things? All the things are really important to people.
No doubt.
So there's an ongoing discussion about that. No decision has been made.
Okay, thank you. Just so you don't chide me on my productivity in this committee, I'm going to move it on to the member for Moreton and then the member for Brisbane. So quick questions and quick answers and we'll be done.
Thank you, Chair. I wanted to move back to the ASX. Obviously, the ASIC inquiry into the ASX is ongoing. We saw some pretty damning shortcomings outlined in the interim report that came out at the end of last year. And I wanted to ask, what role does the RBA have in that? And given the ASX outlined a bunch of practical things that we're going to do to rectify, what role does the RBA have in doing that and in playing a part to make sure that those things get done as soon as possible?
Quick answer, it was ASIC's inquiry and ASIC's report. There are some implications for the way we do supervision with ASIC, making sure that we are working together much more closely. We do work together closely, but there could be some improvements there. But a lot of it falls, because it was ASIC's inquiry, it's going to be to ASIC to make sure that that is all undertaken. Our focus is, as Brad said, stability, financial stability.
Okay. Member for Brisbane.
Thank you. We've covered a lot of ground today. So my question is, what are the couple of big issues, big opportunities you see for the role of the bank going forward in terms of not just financial market resilience and stability in Australia, but also looking to global financial stability?
I don't know. Do you want to go? I mean, we're a small open economy. We don't have a lot of opportunities to set agendas internationally and these sorts of things. But, you know, Chris, any thoughts?
Look, I think the thing that's served Australia very well for a long time is the strength of our institutions, broadly based. We saw that very much during the GFC. And one aspect of that is a lot of automatic adjustments in things that move quickly when needed, when there are stresses coming from offshore. Some of that's the automatic fiscal stabilisers that work pretty well. The Australian dollar being flexible is another really important aspect of that. It often moves because it's an important part of the transmission mechanism, but it can move in reflection, in response to pressures coming from offshore. And it's long played a largely stabilising role. So I think we have a lot to be grateful for just in terms of the way our institutions and setups work.
It isn't something that necessarily would have come out of this hearing today or the recent discussion domestically, but actually, however bad the problems may seem in Australia, when one compares it with our colleagues overseas, you think about Canada right next to the US, you think about New Zealand having over-tightened. Very often our colleagues will say in private, I wish we had your problems.
Okay, thank you. Well, on that note, on behalf of the committee, I just want to extend sincere and warm thanks for your appearance today. The committee secretariat will be in contact in relation to any matters arising out of today's hearing, and you'll be sent a copy of the transcript of your evidence, and we'll have an opportunity to request corrections to transcription errors. I want to thank all the witnesses and all my colleagues for their time today, and with that I'm pleased to declare the public hearing closed. Thank you.